Okay, Amruta, please go ahead.
Thank you. Good evening, everyone. I am C. Amruta Kulkarni, the moderator for this webinar. We are delighted to welcome you all in the webinar being organized by the CCLEA and NPO committee of the ICAI. It is my pleasure to be a moderator in your Know Your Law series 53rd webinar on professional opportunities for CAs in FEMA compliances on 18th of April from 5 p.m. to 7 p.m. organized by the Committee on Commercial Laws, Economic Advisory, and NPO Cooperative of the ICAI. In a short while, we will start this webinar, and I would like to apprise you about the CCLEA and NPO committee before that. I recognize and welcome the presence of the chairperson of this committee, CA Chitare sir. Sir, and
Good.
speaker for the faculty, CA Kusai Govawala sir. To start before this, this committee is focused to encourage the chartered accountants to shape strategy and policy that unlocks economic, financial, and social value while combining analytical foresight with commercial acumen. One of the core areas of this committee is to serve the multifunctional task of analysis, knowledge dissemination, inputs to regulators on policy formulation, to develop and publish technical guidance, background materials, and so on, and also to create awareness for professional opportunities for chartered accountants in commercial laws, economic advisory, and NPO cooperatives. Our eminent speaker today will talk on professional opportunities for the CAs in FEMA compliances. And in this webinar, we hope that the same shall be useful to all the participants. So I also recognize the presence of the other dignitaries present virtually of the CCLE committee. Before that, I also request our chairperson, CA Chandrasekhar Chitale sir, to tell us more about this webinar, the committee, and as well as sir is the
Yeah,
central.
thank you.
He was in the
No,
past chairman of the Ethical Standard Board, chairman of the diabetes committees, chairman of the review board. This year he is heading this CCLE.
no need of my introduction. You can start. Yeah. You can introduce speaker who is more dignified. So I welcome our speaker for the today and eminent chartered accountant, say Goawala, who is always lending support to our committee. And I also welcome chairperson of Pune branch, say Amrita Kulkarni, for agreeing to moderate this particular session, and also office for doing the coordination. As you are aware, that commercial laws committee deals with all the commercial laws excepting corporate laws and tax laws. This FEMA comes under the jurisdiction of our committee. Besides FEMA, enactments like RERA or labor laws or mediation, arbitration. So all the plethora of laws comes under our committee purview. Even the committee is thinking of coming out with a booklet on writ petition, because at times chartered accountants are more familiar with appeal to the appellate authorities, but writ petition also can be at times a better solution for the given problem. If the assessee is facing, say, demand of substantial amounts. Presently, the today's webcast would be centering around the professional opportunities in FEMA. As you are aware, the earlier version of this foreign exchange regulation was FERA, Foreign Exchange Regulation Act. Subsequently, the government opened up and the regulation was taken, management took place in place of regulation. So rather than regulating, maybe user-friendly law was enacted. Although the user-friendly law is enacted, certain penalties are devastating. Therefore, it is necessary for us to know from close quarters, okay, what are the various provisions of this user-friendly FEMA? Although it has been titled as professional opportunities in FEMA compliance, considering the versatility of the faculty, his knowledge background, I'm sure that you will also be able to step into advisory arena. And our more focus is chartered accountant become as an advisor rather than the compliance agent. Yes, they can also comply, but for compliance, they can bring up their office assistants to a level that, okay, whatever forms are there, they can be uploaded or administrative work they can do. But the role of a chartered accountant should be more that of an advisor. And this particular webinar would be really of great help from that on that account. Friends, while we are talking about this FEMA, let me also appraise you that this committee is going to bring out two publications on FEMA. One is relating to FEMA compliance if you are going out for trip or for employment, or your son or daughter or father, mother, any relative is going out, your client is going out. What are various FEMA obligations are there? Whether your ordinary account is required to be converted into NRO account. So all those things would be covered in this particular booklet. And the other booklet is investments in foreign exchange. So these two booklets will come. One booklet, the draft manuscript is already provided by honorable speaker, and the second one by this month end it will come. So in May we will have both these booklets. So thank you, Kusai, for agreeing to our request and sparing your valuable time to share your knowledge with our audience. Thank you, and we hope that you continue your patronage in also days and years to come. Thank you.
Thank you, Chitrai sir, for telling us what is happening there at the Central Council level as well as in this specific committee. We are really happy to know all the endeavors taken up by the committee for the benefit of the fraternity at large. And we are truly grateful for all the contributions by all the contributors as well as the committee members. Thank you so much. It's indeed my pleasure to introduce our faculty for the day, CA Kusai Govawala sir, who is always there in all other sessions, but this specific session he has truly done a lot of research, and as mentioned by sir, he has really gained expertise over the years, and it's a great privilege to introduce you all formally to you, CA Kusai Govawala sir. He is a fellow member of the Institute of Chartered Accountants of India, and he has 37 years of experience. He is a partner of Messrs. GKDJ and Associates. He was nominated for 3 years on the Ind AS Implementation Committee of the WIRC of ICAI. He was nominated on the Research Committee of the WIRC of ICAI for the year 2021. He has conducted numerous lectures on varied topics like tax audit, IFRS, Ind AS, auditing standards, ICDS, company law, GST, and all the subjects. In the seminars conducted by all various institutions, he was a part of the group which has authored and reviewed various publications like the guidance note on the internal audit of automobile industry. He was also a part of the group which compiled books published by ICAI on office management, manual for CAs in practice, procedural guide for ease of incorporation of company, procedural guide for registration and modification of charge, guidance note on audit of charitable trust, guidance note on tax audit under section 44AB, implementation guide on audit trail, peer review manual, and to name the subject, and sir has his contribution. Sir, really over the years you have gained so much of experience and also shared the experiences being contributor to various seminars and conferences. We are really grateful to you for today, for today's session, and as well as the valuable time. Without taking much of the time I request you to please take the session, and the stage is going to be all yours. And to all the participants, the Q&A tab will also be there, and the chat box will also be there. You can put in the queries. In the last 15 minutes of the session, we can take the question and answers, and sir will be navigating the session now onwards. So over to you, Kusai sir, for the further presentations. Thank you.
Thank you, Amruta ji. The chairman of the committee, Chitle sir, the chairperson of Pune branch, Amruta ji, other dignitaries on in the session, and my fellow professional colleagues. A very good evening to all of you. Today we are going to discuss, as Chitle sir has mentioned and Amruta ji has mentioned, about the FEMA compliances, particularly in relation to our as a professional opportunities to chartered accountants, as to how are we going to advise our clients, how are we going to comply with the FEMA requirements, what are FEMA requirements. I would like to share with you in the next 2 hours whatever experience I have gained over last 21 years, 25 years of this FEMA working. It is a very interesting topic, and I would like to share my practical experiences, the issues which we deal with when you are handling FEMA matters. Now, before FEMA came in, there was FERA 1973, which was a little stringent and a very highly, punitive regulation. And FEMA changed the entire scenario. In 1997 or 98, when FERA was in vogue, the India's foreign exchange reserves were in the range of around 27 to 28 billion dollars. Whereas just now recently in April 24, the figure is around 645 billion dollars, which is our foreign exchange reserves. And to a certain extent, yes, the credit goes to the regulation, the liberal policies which FEMA has brought in and permitted a lot of inflows into the Indian economy, and which has impacted the Indian economy considerably, because when the money comes in, India has become a global village, and where you can get money from an investor anywhere in the world, and even you can invest anywhere in the world through various modes available in the FEMA. So a lot of liberties have been provided under FEMA. I recollect during those FERA times in 90s, when a very renowned business house, their MD, was arrested just for having a $100 note in his possession. Today, the FEMA has changed a lot, has changed the situation. Today, every person can retain about $2,000. Every person can retain $2,000, and there is no issue. It is compliant with FEMA. So FEMA has been liberal. FEMA has permitted a lot of things inflows into the Indian economy, and we can easily comply with those requirements. So this is how the change has brought in a lot of development to the Indian economy, and India has benefited by the foreign money, foreign investments. It deals with transactions between person resident outside India and person resident in India. So this is the basic concept of FEMA. It doesn't deal with person resident outside India and resident outside India. Two people doing whatever they do outside India, India is not concerned. And what person resident in India and resident in India, FEMA doesn't really bother. It is only when you are dealing with a person resident outside India with a person resident in India, then FEMA comes into picture. Then there are two types of transactions, current and capital account transactions. Current account transactions are liberalized to get it to a great extent. We are current account convertible as of now. As far as the capital account is concerned, yes, lot of permission, lot of things are allowed, permitted. Of course, subject to certain restrictions, subject to certain conditions being complied with. We will discuss all this in detail in the next 2 hours. Now, RBI has delegated a lot of their powers to the AD bank, the authorized dealer, that is a bank, and it is all specified in the regulation as to what is permitted and what is not permitted. And if you follow those regulations and if you comply with those conditions, there is no issue. You can go under automatic route. If your particular case comes under automatic route, you did not go to the RBI for any approvals. You can straight away do a transaction with a foreign investor. And you need to comply with certain formalities, which is very simple, but it has to be done. And that will be enough for you to satisfy the FEMA regulations. Now, how this FEMA has been evolved, FEMA regulation, what we mean by FEMA law. The FEMA Act as such, the FEMA Foreign Exchange Management Act 1999 is a very small act. It is about only 49 sections, very simple act. It basically says okay, you can't do a lot of things. Okay, it starts with that feature, okay, you can't do a lot of things, except what is provided in the regulation. So what is given in the regulation, you can do it. What is not given in a regulation, you cannot do it. That is how the FEMA starts. So what are the regulations? There are multiple regulations for each and every transaction, for each and every types of transaction. Like there is a regulation for acquisition of property. There is a regulation for current account transaction. There is a regulation for investment into any securities in India. There is a regulation for investment outside India, overseas investments. There is a regulation to do external borrowings. So there are multiple regulations, and for each regulation you have to see what are the conditions under automatic route. Or each regulation has got automatic route, and if you comply with those things, then you don't have to go to RBI. The authorized dealer is enabled to complete the transaction. So you have to only go to the AD bank and complete the transaction. The way the FEMA has been liberalized, even a resident Indian can remit about $250,000 outside India. A resident Indian can buy properties outside India, can buy shares outside India. of course, subject to certain conditions, but it is very simple now. It is not that difficult. You don't need to go run to RBI to get approvals. You have to just comply with whatever conditions have been laid down, and you can do your transactions. And of course, the monitoring is by RBI, but it is a very low level monitoring. It is not a very close monitoring. AD Bank reports this to RBI, whatever transaction happens. And if at all they find that it is not in compliance with the regulation, then only the query is raised. Otherwise, there are no queries. And of course, the enforcement directorate is the one who is the policing the entire regulations. But it is only comes at a very last stage when one person is not complied or there is a malified intention. Then we will discuss as to where such situations will arise. Of course, non-compliance attracts penalty. FERA was more of criminal law where you can immediately be prosecuted and put in the behind bars. Whereas FEMA is more onto civil, where they permit. There is more of a financial penalty rather than criminal, prosecutions. Of course, in certain situations when there are situations I will discuss later, a prosecution also can be initiated. Now, what is our agenda today is opportunities for CA. That is the basic objective, basic title of the entire thing, area of practice. And what are the meanings of various definitions which is provided in FEMA, which I will be discussing, because unless you know all these provisions, you will not be in a position to advise a client. You will not be able to render that kind of service which is expected from a chartered accountant. So what are the different meanings of non-resident, other key definitions we will discuss. Different types of bank account that a non-resident person can open, we will discuss that. Remittances for non-residents, what are the allowed remittances that is permitted for non-resident, that also we will discuss. Inbound investments and outbound investments, both we will discuss in detail as to what are the provisions requiring this particular investment. What are the last but not least, compounding and penalties, we will discuss in this situation. Opportunities for CA, what are the kind of opportunities that we are looking at today? When you do a statutory audit, there is a no-clar issue. Any non-compliance of any law and regulation, we are supposed to report. So FEMA is one of them. So as a statutory auditor, you are supposed to know FEMA provisions, whether there is any violation in the FEMA in that company's financial statements, you are supposed to report. That is also one of the very important aspects of an auditor. Now, other aspects are FDI, which is the foreign direct investment coming in. ODIs, which can be advised by a chartered accountant as to when can an FDI come in, what are the principles, what are the policies, what are the procedures to be followed, whether a particular company is eligible to get FDI, which are the source which is eligible, what is the method of getting that money in, all that we will be discussing today. LRS, this is what I said, the liberalized remittance scheme, which is for a resident, that also we will discuss. Now, which are the forms that we are required to file? As Chikle sir has mentioned, that forms basically is an administrative procedure, but chartered accountants are also required to certify certain forms. So I will also explain you what is the care to be taken to certify this form, because when you are certifying a form, you are also giving your own commitment to the AD Bank that yes, this particular transaction is correct, and Reserve Bank and AD Bank is relying on your certificate as a chartered accountant. So form APR, form ODI, all require chartered accountant signature. Form 15CA, 15CB are the tax issues, but that also requires CA certification. There is an advisory in respect of FEMA compliances. Many companies or entities, they require support and in terms of advices as to how do we comply with FEMA. There, the chartered accountant can play an important role, because we are already aware about this FEMA laws, and we can always advise them about how we can comply with this provisions. Implementation of all this FDI, FTTR also is one of the aspects, if we can handle that. Valuation of shares is also one of the key aspects in the getting the money in, or so that also we will need to see how we value the shares. Then compounding and representing before RBI, if there is any compounding issues, or if there is any notice from the RBI, if any representation is required, a chartered accountant can represent before the RBI. So we should know the FEMA laws, then only we can represent, like how we do it in income tax. So now let's understand the meaning of non-resident and other key definitions we will discuss. First important thing is what are the different kinds of status of persons as defined in So a person resident in India is defined, it is given, and a person resident outside India is the one who is not a resident in India. So it is other way around. So a person resident in India is very clearly defined under the Act. We will discuss that in detail. And in case of person resident outside India, there are three categories of person. One is the non-resident. See, when you say person resident outside India, it is a broad category. Out of that, there are three subcategories. One is the non-resident Indian. That means the person who is resident outside India, but is also citizen of India. So he's getting some more privilege, more benefits under the FEMA. So he is a non-resident Indian. He's called non-resident Indian. Then there is another person who has got roots in India, who has gone outside India, or who is born outside India, but having roots in India. But say he's got citizenship of US or citizenship of other countries. But he has got his forefathers or parents, or at any point of time he was citizen of India. He has got roots in India. So that person is also getting a benefit of overseas citizen of India. Earlier he was called as a person of Indian origin, but now in the FEMA they have changed it to overseas citizen of India. But the benefits are similar. We will discuss as to who is qualified to be overseas citizen of India. And then there are others who are pure citizens of outside India. But we are not the citizens of India, pure citizens of other countries who have got no roots in India. There the benefits are limited. They cannot do a lot of things which a non-resident Indian can do. So we will distinguish as to what an NRI can do, what OCI can do, and what a pure foreign citizen can do. This is very important that we need to understand this concept. Now let's understand the definition of person resident outside India. See, people get mixed up with the definition of income tax and FEMA. There are two different concepts, two different principles. Income tax purely goes by number of days, whereas in the FEMA, it is the intent which is the more predominant compared to the number of days. It is more important is the intent, not the number of days. Of course, number of days was not there earlier. It has been introduced in FEMA. It starts with as a person resident in India means a person residing in India for more than 182 days during the course of preceding financial year, but does not include. Now the intent comes into play. That there are three basic intentions. One, a person going outside India for employment, a person going outside India either for business, or he is going outside India not for employment, not for business, but for an uncertain period. He is going there. Suppose if his son is staying in USA and his father, he is calling his father out there, his parents out there, now you come and settle down, you stay with us for an uncertain period of time. He's got a long-term visa, and that two people go there, they become non-resident because they are going to stay for uncertain period of time. They may not be going for business, they may not be doing any business, they may not be going for employment, but they are going to stay for uncertain period because of their visa and because of their intent. Then they become a person resident outside India. So this is a exclusion from a person resident in India. So now here there is one very interesting point. Suppose a person has stayed for 182 days in the preceding financial year, or maybe he has stayed for so many years in India. Suddenly one fine morning, let's say in April, he gets an employment offer from a foreign country and he leaves India. Now, when does he become non-resident? That is very important because all the requirements to comply as a non-resident will begin when he becomes non-resident. Now, the moment he steps out of India and he's going out for employment, then he becomes a person resident outside India when the moment he leaves India and he reaches outside India. So he, from that day onward, irrespective whether he has stayed for 182 days in the preceding financial year, doesn't matter. But he becomes a person resident outside India from the day he has traveled outside India for employment or for business or for a certain period. Now, whatever is applicable to a person resident outside India is applicable to him. So this is very important. From that day onwards, he has to comply with the FEMA provisions relating to person resident outside India. And I will tell you what he is supposed to do little later during our lecture, what he is supposed to do it when he goes outside India, what are his obligations and what are his benefits, what we will discuss. Now again, another case is when a person who comes to India, otherwise then for employment, or suppose if a person is staying outside India, suddenly he comes to India, but he is not taking employment in India. He is not taking any business, but he is not coming in to stay for a longer period in India. So he is still a person resident outside India. He will not be considered as a resident. Only when he is coming here for, suppose the person is staying in Dubai and he he leaves his employment in outside India, and he is taking an employment in India, and he comes to India. The moment he lands in India, takes an employment, he is a resident in India. Then, irrespective of number of days stay, it doesn't matter. He will become a person resident in India, and all things what is applicable to a person resident in India will be applicable to him. So this is very important. Now, for a non-individual entities, like for example, companies, LLP, firms, everything, all here the important principle is whether this company or this LLP, they are incorporated under the Indian laws. If they are incorporated under Indian laws, then they are resident in India, irrespective of their management, irrespective of their shareholding, doesn't matter. Everywhere, the moment they are incorporated in India, they are considered as resident in India. It doesn't matter who is the owner, who is the management, doesn't matter. Like in your income tax, there is a concept of place of effective management. This concept is not there in FEMA. So irrespective of whoever is the board of directors, the company incorporated in India, immediately, they are considered as a resident in India, and all provisions applicable to resident in India is applicable to them. And now, of course, there is other two areas also. When office, branch, or agency in India is owned or controlled by a person resident outside India, also becomes a resident in India. So if there is an office or a branch and agency in India, which is controlled by a foreign entity, still that will be considered as a resident in India, and all the provisions of residence will be applicable to that particular office or a branch office. And similarly, if there is a office or branch established outside India, but controlled by a person resident in India, that also will be considered as resident in India and not considered a resident outside India. So even that will be governed by the Indian laws. Now, as I mentioned to you, OCI, Overseas Citizen of India. Earlier, this category was called as a person of Indian origin. Matlab, if any person who had a passport, who held any passport, Indian passport at any point of time, and he now migrates, let's say, to US, and he gets a green card and he becomes citizen of USA, and he gives up the citizenship of Indian citizenship, he still continues to be a PIO and enjoys whatever benefit is available to a NRI, and PIO more or less similar benefit is available. Slight difference is there, but more or less they have got a similar benefit. So PIO has got a special status because he's got roots in India. Even suppose he did not at any point of time held Indian passport. He was born in the USA and he has got US citizenship, but his parents or his grandparents at any point of time were Indian citizen, he will still be recognized as a PIO. Now, as far as overseas citizenship of India is concerned, now there is a different regulation, more or less similar provision, but there is a slight different regulation. PIO never required any registration. By the nature, it became a PIO. But in case of OCI, he needs to register with the passport on the website of the passport under with the MEA, Ministry of External Affairs. There is a passport site http://passport.gov.in. He has to register as an OCI. He has to submit all the documents evidencing his OCI. Yes, he is an OCI. And then he will be given an OCI card. Now, the reason he is getting an OCI card is because when he is a citizen of USA or suppose any other country, he doesn't need a visa to enter India because he has got roots in India. So that is the reason his OCI card will permit him multiple visits to India without any visa, and of course get all the benefits that is available to a person of Indian origin or a non-resident Indian. Similar. Now, even suppose, for example, an Indian citizen having Indian passport goes abroad, goes to USA, marries a foreigner, pure foreigner, who is the wife is a foreigner, and she is married to an Indian citizen. Now, what happens? Whether that wife will get OCI card? Yes, but after 2 years of marriage. Let that marriage subsist for 2 years. After 2 years of their marriage, that wife can also be eligible for getting OCI card because there is a roots now with the husband, and she also will be eligible for all the benefits of the OCI. Now, a person going out of India, as I mentioned to you, what are the obligations? What is he supposed to do? When he is going out of India for employment, for business, for long-term uncertain stay, the moment he is leaving, he should inform his bank that, look, I am now becoming non-resident. I am becoming person resident outside India. I cannot now that person resident outside India or a non-resident Indian cannot hold ordinary savings account, ordinary current account. It cannot hold. He will have to hold a non-resident, either NRE account or NRO account. He cannot hold a normal savings account or a current account. It is a violation of FEMA in case if he continues without any. I've seen many of the people who don't know this provisions. They leave India, they forget their accounts are in India. They are all savings account, all current accounts. They're abroad for 10 years, 15 years, and they don't bother to change their account to NR status. And then there is a compliance issue, and suddenly when RBI will issue notice, there will be a huge penalty or a fine. So which is a very serious thing, which we will discuss as to what are the consequences. So immediately when you leave out of India, you should inform your bank, not only your banks, even you have got a share with the companies. Inform those companies that yes, I have become non-resident. Now please change my status from resident to non-resident. And other investments like mutual fund, which are all scripts, you have to inform those relevant mutual fund holders that yes, I have become non-resident, because there are different rules for for non-residents. So this your investment will be marked as a non-resident by those companies and by those mutual fund entities, and even by the banks, that will be converted into NRO account and NRE account. We will go into detail as to what are the NRO and NRE account in detail. Now the next area is bank account. NRO, non-resident external account, non-resident ordinary account, foreign currency, non-residential account, non-resident account, special non-resident rupee account. These are the main 4 types. There are many other types, but I am dealing with only those 4 major ones which are commonly used. Now, non-resident external and non-resident ordinary are basically your operating accounts, which you had earlier savings, a current account which you were operating. FCNR is more of fixed deposits, foreign currency, non-resident account, which are also actually external accounts. Okay. Now let me explain you the difference between NRE and NRO in a different analogy. I mean, see, people may be aware about NRE and NRO, but I will explain you in such a way that you will understand what is NRE and what is NRO in a very clear manner. I will give you an analogy of a person traveling abroad. We all travel abroad. And when we pass immigration, our Indian immigration, and a stamp is put on our passport that now we have exited Indian immigration, and you are still waiting at the gate to board the aircraft, you are technically outside India, but physically in India, because you're still in the Indian airport. Whereas as far as the immigration is concerned, a stamp is affixed on your passport that you are exited India. That means technically you are out of India. Now, similarly, NRE account, physically in India, the account is maintained by a bank in India in Indian accounts, but it is technically outside India. That means any money, any balance lying in that account, you can freely move out, remit out anywhere in the world. No questions asked. No bank will question you where you want to take it out or where you want to. You have passed that immigration stage, because only at the immigration stage you can be stopped, why you are going, where you are going. Somebody can question you. But once you have crossed the immigration, you are free to travel anywhere in the world. So similarly, your NRE money, when it is in your balance in the NRE account, it is a freely repatriable account. It has crossed that immigration. You don't need further immigration on that. So it is money outside India, actually literally money outside India. Whereas NRO account is a balance which is before immigration. Now, any balance that is there in the NRO account requires certain procedures and processes with the AD bank to be able to remit outside India. You can remit out of NRO account money outside India, but with a certain procedures and processes, with certain approvals of AD bank and all that. Without that, you cannot send it out. So you have to cross that immigration line. It is before your immigration. So NRO money is technically and physically both in India and not outside India. So it is not a freely repatriable money. Now, what is that immigration which you have to pass when you have to transfer money out of India? Yes, that immigration is a tax aspect and of course the compliance aspect. For example, any money going out of India, the first most important parameter is that it has to be tax paid money. You cannot remit money outside India without making payment of the tax applicable on that particular amount. Suppose if there is a income which is going outside India, you have to ensure that the tax is fully paid on that. And once the tax is paid, then only the money is allowed to be remitted outside India. Otherwise, it cannot be remitted out. If there is any payment made outside India without payment of the applicable taxes, then it is a violation of FEMA, because FEMA also requires you that only a tax paid money can be sent outside. Now that what is that immigration check? That is a form 15CA and 15CB. which is the check which is required to be processed, and the AD bank will look at this 15 CA, 15 CB, and then only they will be able to permit you to remit the money outside India. Now, what happens is, if in the NRE account, suppose you want to deposit money, what are the kind of deposits allowed? Only from outside India, because it is a freely repatriable money. Any money coming from outside India in the NRE account can be repatriated outside India anywhere in the world, no questions asked. But even the local money can go into NRE directly. Now, how it can go directly? It has to cross the immigration first, because it has to pass 15 CA, 15 CB. You will have to, suppose, for example, a person is earning rental income. Rental income is freely repatriable outside India, of course, subject to payment of tax. So if a non-resident Indian is owning a property in India and he is earning rental, the tenant can directly deposit the check in the NRE account, provided 15 CA, 15 CB is filed. If 15 CA, 15 CB is not filed, he has to deposit it in NRO account, and from NRO to NRE, when you transfer, you need to do 15 CA, 15 CB. So that is a requirement. So immigration crossing has to happen with the 15 CA, 15 CB only. Now, 15 CA, 15 CB, what is 15 CA, 15 CB? 15 CA has to be filed by the person who is remitter, the non-resident person who wants to remit. And 15 CB is to be filed, given by the auditor, chartered accountant, not a chartered accountant, who will verify whether this money which is coming in is tax paid or not. He will certify, yes, this money is tax paid and the tax is deducted, or if not deducted, this is the withholding tax that is required to be paid before this money is allowed to be remitted. The AD bank will ensure that this money the tax has been first paid, and then only they will permit the remittance outside India. So this is the control point of this tax payment. Now, in some cases, 15 CB may not have a tax liability because this particular item or the payment does not attract tax under either DTA or the nature of payment. It does not have any tax implication. So then in that case, the 15 CB, the auditor will certify that yes, there is no tax liable to be paid on this. And based on that CA certificate, the AD bank will release this payment. So now the responsibility of a chartered accountant is very immense, that when he is certifying 15 CB, he should examine all the relevant provisions, whether there is a tax liability, section 9, and DTA provisions, or whatever is applicable, relevant applicable on that particular transaction, and then only should certify 15 CB whether there is a tax liability or not a tax liability. Foreign currency non-resident accounts are also outside India. It is like equal to an NRE account only. It is money received from outside India, which is kept outside India in foreign currency. It is not, see, now non-resident external amount are designated in Indian rupees, whereas foreign currency non-resident accounts are designated in the foreign currency, like it is designated in US dollars only. Suppose you receive money in US dollars, you can retain it in US dollars outside India, but in India, but it is designated in US dollars, so that you don't lose out on the exchange conversion losses. Whereas in NRE account is always designated in Indian rupees, because the whatever money you have sent, what money you have received in the dollars or in any other currency gets converted into Indian rupees, and it is stored in the NRE account. But it is in Indian rupees, designated in Indian rupees. Whereas the foreign currency non-resident accounts are designated in the foreign currency. That is a convertible currency. Whatever is the convertible currency, you can keep it, so that you don't lose out on the exchange benefit. Special non-resident rupee accounts are meant for pure foreign citizens who are not permitted to open NRE account, can open special non-resident rupee account, and then in this they can only do business transactions. They cannot do any other transactions. There are restricted transactions which you can do. And again, here also there is a control by the AD bank as to how the money will be remitted. There are various rules and regulations for that. One has to comply with those things. Now, interest on NRE and FCNR account is exempt from income tax because they are money lying outside India, and Indian authorities have no provisions to tax that income. And any NRE and FCNR accounts are fully repatriable, as I mentioned to you. Balance in NRO account can also be repatriated under a 1 million scheme. We will discuss in detail with 1 million scheme. So this is what I said. FEMA has liberalized the economy to great extent, and allowing $1 million for financial year to be remitted outside India by a person resident out, by a non-resident Indian. And whereas a resident Indian can remit about $250,000 per person per financial year. We will discuss that in detail later on. Now, what are the kind of remittances that is allowed to a person is dividend is allowed. Dividend is fully repatriable. Suppose if a non-resident person is earning any dividend or interest or rentals or any other current income in India, he is in a position to remit it outside India, subject to payment of taxes, of course. This money can directly either go to NRE account or can go to NRO, and from there to NRE or directly outside India. Both options are open, but you have to do the process of 15CA, 15C. Remittance of assets. Now, as far as the current income, as I said, it is fully convertible. You can do it. But as far as the assets are concerned, it is covered under the capital account transactions, and there are restrictions. But there are restrictions are very liberal. I mean, it is not very difficult, but still you have to go through some process. If you sell any property, yes, you can remit your whatever money you had brought in. Suppose when you acquired the property through foreign money, through your outside money, whatever you brought in, the same amount of dollars you can remit outside India, no questions asked. But as far as the profits are concerned, it can go under 1 million scheme. But whatever you had brought in can be remitted outside India. As far as sale of security is concerned, you had brought in money for investment in securities, in any shares in the Indian company. You are allowed to freely repatriate. When you sell those shares, you are allowed to freely repatriate the sale proceeds outside India, of course, subject to payment of taxes. Without payment of taxes, you cannot remit anything. Now, coming to the 1 million scheme. Now, what is this 1 million scheme? 1 million scheme basically deals with a non-resident, a person resident in non-resident Indian is permitted, even OCI is permitted out of their balance in NRO account. Whatever is the balance in NRO account, it can remit money outside India. And it could be out of any accumulation out of anything which is in its current account. It could be old balances also. Sell of any property, sell of any items in India which were non-repatriable, but it is coming to current account, and we can now repatriate outside India under 1 million scheme. We can do it every financial year. That means suppose if in March 31st, if you have sent 1 million, you can remit in April also another 1 million. But then during the one financial year, it cannot exceed 1 million. There are certain conditions also. We will discuss in detail as to how we are to deal with it. Now, as I mentioned to you, current account, we are quite convertible and we are allowing remittances outside India. But there are certain prohibited items which you cannot remit. There are certain lotteries or winnings of race, all those things we cannot remit. So there is a schedule there are current account transaction regulations. As I mentioned to you, FEMA is comprising of FEMA Act, which is a very small act, but there are so many regulations. Each regulation will define what, for example, current account regulation will define whatever you do, supposed to do with the current account transaction. So in this current account regulation, we are allowed, there are schedule 1, 2, and 3, which deals with how do you remit. As far as schedule 1 is concerned, it's a clear-cut prohibition. Nobody can permit, even the AD Bank, neither RBI can permit you to remit money outside India. It is a clear-cut prohibition list because the government doesn't want you to remit for those purposes. Then there are restricted lists with permissions. Then there are certain items like you are doing for some exhibitions or something like that, you have to take some permissions. And those permissions are with those ministries. And you have to take those permissions and remit money outside India with those permissions. Then there are schedule 3 is more liberal with limits. You can remit, like for example, if you are availing some consultancy from outside India, then up to $1 lakh you can remit for availing consult. Suppose you got a project in India and you appointed an architect from Singapore, you can pay up to $1 lakh USD to that architect and remit money under this particular thing. Maintenance of close relatives. Suppose there are parents are staying here, there is a close relative is staying outside India, and you want to maintain those close relatives. They don't have a source of income outside India. You can remit outside India for maintenance of close relatives. Gifts from resident to non-resident up to USD 2,50,000 you can remit. Medical expenses as per estimate from hospital. Suppose you people go outside India for medical treatment, like somebody goes to UK or USA, wherever, for medical treatment, and over there it is expensive. So whatever is the medical estimate from the hospital, you can remit to do the medical treatment. Even educational expenses also of your children, you can remit money to see that they are educated. And again, one more very interesting thing. A student, when they go out of India, now they are not going for employment, they are not going for business, they are not going for uncertain period, they're going for certain period, because that education may be for 2 years or 3 years. But still, as per a new circular has come up, the circular says The students going out of India will be considered as a person resident outside India, non-resident Indian, and they will get the same benefits as a non-resident Indian will get. So a student also will get that benefit, but even student may not have any income to remit outside India, so that parents can fund that money, because their parents may be resident in India, so they can fund their expenses for their education abroad. Now, again, just to recap the 1 million scheme, what are the terms and conditions? Only non-resident Indian and OCI is eligible. A pure foreigner cannot remit under 1 million scheme. So it is only beneficial available to a Indian or a person with roots in India. So it can be remitted 1 million up to in one financial year. To be remitted from the same account, you cannot have different accounts and remitted. You have to have one bank account, designated bank account. The reason is they want to control the amount which you are remitting. So suppose if you have remitted 1 million in from one account, you remit another 1 million from another account, the bank may not be able to control it. So bank has required that you should have only one bank account designated for this 1 million, and you have to give a declaration to the bank that this is the only account for which I am remitting, and there are no other accounts. So if you have done some remittance from another account, then it is a violation of FEMA, a wrong certificate you are giving to the bank. Source of fund, you should specify what is the source from where you have got this money, and whether it is tax paid. Again, 15CA, 15CB is required to show that, yes, there is a tax payment. Now, again, here, very important, although that limit is 1 million, but suppose, for example, there is a daughter of a person in India, resident in India. Daughter is a non-resident staying now in USA. Now, a resident Indian cannot give 1 million gift to the daughter in India. And from there, she cannot remit $1 million outside India, because maximum that a resident can give gift is $250,000. So that limit is already crossed. So you can only give up to 250,000, and the remittance to that extent is only 250,000, not 1 million. From the other areas, yes, she can have. Suppose if she has other balances, she can remit, but not from the gift. If there is a sale proceeds of assets, yes, from that she can remit, or he or she can remit. A non-resident person can remit. The remittance should be net of tax. 15CA, 15CB. FEMA declaration is required that it is within that 1 million scheme, 1 million procedure. The source is as per the FEMA. A2 form A2 is basically a instruction to the bank to remit, like how we give instruction for a demand draft or RTGS. Similarly, A2 is for giving the instruction to the bank to remit money outside India to particular account. So that is a form which the bank has prescribed, and you have to mention the codes and all that, which code you have to utilize. Now, coming to the acquisition of property in India. This is a very interesting chapter. Now, Indian citizen. Now, here, the point is a person resident outside India who are citizens of India or OCI are only permitted to buy property in India. Now, here, even if a pure foreign citizen who has got no roots in India comes and settles down in India, stays for 10 years in India, he becomes resident in India, because now he is staying for 10 years. He is employee in some company in India and is working for 10 years and staying in India, but he is still a foreign citizen. He is not allowed to buy property in India because he is a foreign citizen. Now here the property acquisition is linked to the citizenship and not the residential status. So only citizens of India who are non-resident or OCI. OCI may not be citizen of India, but they have got roots in India. They have got an OCI card. And only now here again, there is a little dichotomy. Most of, when initially in FEMA, the term was used as PIO, and all along the regulations, the word was PIO. In OCI came in, they have modified most of the places. Only in this acquisition of property regulation, the PIO word still continues. For what reason, I am not able to understand, but it is still continuing. But PIO and OCI are more or less interchangeable. So we assume, and somewhere in the RBI guidelines it was mentioning, they have mentioned OCI. So we assume that OCI and PIO are in similar platform. So here OCI is allowed, NRI is definitely allowed to buy a property. But what is restricted? A normal Indian citizen who is resident in India can buy an agricultural property, but a non-resident Indian or an OCI cannot buy an agricultural property, cannot buy plantation, cannot buy farmhouse, is not allowed by NRI. But there is a catch here. There is a different scenario here. Suppose there is a father who is a resident in India, staying in India, who is owning agricultural property. Now he has prepared a will and he is bequeathing his property to his sons, his children, and one of his children is non-resident in USA, is staying in USA. Now father dies, and this property, agricultural property, goes to that non-resident son. Whether he can acquire, because now, as we discussed, that a non-resident Indian cannot acquire a property, agricultural property or a farmhouse. But here he is not acquiring; he is getting as inheritance. FEMA permits that. Okay, you can, because there is no choice. You cannot say that now, okay, become resident to get this property. You cannot do that. So they said, okay, because this is not an act of acquisition. You have not done anything positively. It is by way of default, where the father has died and father has left this property in the name of the non-resident child. So he will acquire this, I mean, he will hold this property. But point is, he cannot sell it to any non-resident. He can only sell this to the resident. So he cannot, suppose if he's got other properties in India, he can always sell it to non-resident or to anybody if he decides. But as far as agricultural properties are concerned, he cannot sell it to any non-resident person. He can only sell it to the resident in India. And those proceeds of this sale proceeds cannot be repatriated outside India. It has to be in India. So that is another one condition which he has to comply with. A foreign spouse of NRI PO can become joint owner. It cannot be the main owner, but it can become the joint owner in the property. But not, of course, agricultural, they cannot hold, they cannot acquire only. But as far as the if they acquire any residential or commercial property, suppose if a non-resident Indian is staying in USA, he is acquiring a property in India, and his wife is a pure foreign citizen, she can become a joint owner, but she cannot be the first owner, or she cannot be the main owner. NRI PRO, as I mentioned to you, it can be inherited. NRI PRO can sell existing agricultural property only to resident. I mentioned that. And a resident can give property other than agricultural to NRI or OCI. So gifting is allowed between NRI and OCI, but not agriculture. Agricultural property you cannot give to NRI or OCI. NRI can give any property to resident, but even agricultural property which is acquired through the inheritance, it can give to any resident. Now, again, as I mentioned to you, what amount he has brought in by way of inward remittance can be remitted outside India. No questions asked, of course. And as far as profits are concerned, it can go under 1 million scheme, because that is not what is brought in. It has got extra which is earned over a period of time. That net of taxes can be remitted under 1 million scheme, because that will go into NRO account, and from NRO account it can be remitted outside India. Now, here again, remittances are only permitted of 2 residential properties. He can hold more residential properties. There is no bar. Suppose a non-resident person can hold 5 properties in residential properties in India. But when he sells, he can remit only money for 2 properties, 2 residential properties only, not for 3rd property. He cannot remit outside India. So that is a restriction. Now, as far as security is concerned, when the non-resident Indian can buy for Indian securities, Indian shares, and whatever sale proceeds are realized, he can repatriate outside India net of taxes, of course. That goes without saying. So whatever you realize, you can remit outside India. If it is on a repatriable basis, if there are certain investments on a non-repatriable basis, that cannot be remitted outside India. Now, just to, tax is not a subject of today's discussion, but tax comes in because FEMA says net of tax. So you, as a chartered accountant who is advising on FEMA, should also know what are the implications on tax. And there is a double tax avoidance agreement with so many companies, so many countries. India has DTA with so many countries to avoid double tax. Why? Because sometimes the person is taxed because of his status as a non-resident, and also being taxed in another country on an accrual basis. So there is a double tax because of this dichotomy. So now DTA says, okay, they will do internal sharing between the countries and say, okay, some tax will go here, some tax will go here. This is how they have structured the whole DTA. And they are on the USCD model, which defines which are the areas on which the tax will be distributed. So how it works is, suppose, for example, a person who is having a property in India, let's say he sells the property in India, and that person is a green card holder in USA. He is supposed to offer that income even in USA, because in USA, his world income, he's a resident of USA. So his world income is taxable in USA. But because the property is in India, that particular income also for that person gets taxed in India. Now, if the Indian tax is 23%, if the US tax is 28%, he will pay 28% in USA, and this 23% which he has paid in India, he will get set off over there. So maximum he will pay is 28%. He will not pay more than that. 23 in India he has paid, and the 6%, 5% extra he has paid in US. So in totality, he will pay 28%. So this is how the entire DTA mechanism works. Now, again, whichever is beneficial, if as per Income Tax Act, if the tax is lower, and if as per DTA it is higher, whichever is beneficial, that will be applicable. Generally, the DTA rates are lower than the income, normally 195. So naturally, DTA is more beneficial. Now, 15 CB as an auditor will have to certify. So whatever is the tax applicable, he has to certify whether there is a no tax or there is some tax, and based on that, the AD bank will deduct tax and permit remittance of the money. Now, there is one very interesting provision, make available concept for technical services. Now, what is this make available concept? So when you are doing this 15 CB, you must know this particular provision. For Singapore, suppose if you have availed, suppose a resident company in India avails some architectural services from Singapore-based architect. Now, when the Indian company is remitting money to that Singapore-based architect, now the 15 CB is applicable, and tax, whether the tax is required to be paid is important. Now, under DTA, the taxability of purely a technical service, because you have to first identify whether it is a technical service. Only if it is a technical service, then only you apply make available. Otherwise, make available concept is not applicable. Now, when there is a technical service, you have to see whether there is a make available of that particular service. Now, what do you mean by make available? Now, that architect who has designed that particular drawing or particular model or whatever he has done for that company, when he has supplied that services, whether he has taught them how he made that drawing, how he did that, if he has made available the technology of making that particular drawing to that company, then TDS is applicable in India, because then the tax is applicable in India. If that make available is not there, that means that architect only made that design and send it to them. And now that company is going to use that design to make his project, but they don't know how that design was made or how that architect worked out that design. So then it is not make available, and the tax is in Singapore. There is no tax in India. So the payment of that consultancy fees will go without any withholding tax. That architect will pay its full tax in Singapore. No tax can be levied by the Indian entity. So this is how the DTA has been structured. If it is a business income, then you have to see the P, and you don't have to see the make available concept. Whether the company has a P in India, then only the taxability arises in India. Otherwise, no tax in India. Now, then there is a limitation of benefits clauses in various DTAs. For example, in Mauritius, this is particular applicable. In Singapore treaty also, this LOB clause is there. UK, USA, all these treaties, you have this LOB. What is this LOB clause? See, earlier, this clause was not there. This has been subsequently introduced. Now, what has happened is, Mauritius particularly. Now, when an investment comes into India, now say let the US company who wants to invest into India, it could have directly remitted money from a US to India for buying the shares of the Indian company or subscribing to the shares of the Indian company, but they don't do that. What they do is they will route that entire investment through Mauritius, because Mauritius is the beneficial DTA. So they do treaty shopping, and they route all their investments. There are substantial portion of our investment which has come into India has come through Mauritius route. And I had gone on a holiday to Mauritius, and I particularly visited Port Louis, which is the capital city of Mauritius. And then there is a lane, there is a road, and there is a building. I forgot the name of that building. That building houses all the lawyers and some those consultants out there. Those lawyers will form a company for those investors in Mauritius, and each offices will have hundreds of such entities, registered offices, and they don't need a presence in that Mauritius. They have to only open a bank account. The money comes from the US company to that Mauritius bank account and immediately leaves for India as a share investment. That is what was happening earlier. Now, why it was happening? Because under a DTA between India and Mauritius, capital gain tax is leviable under capital gain tax on the shares of Indian companies when you sell is leviable in Mauritius. That is what the DTA provides. And in Mauritius, there is no capital gains. Now, what happened is most of the investors, they used to make huge amount of profits, capital gain in India. Since the tax is in Mauritius, no tax was paid in India. Mauritius, since there is no capital gains, no tax was paid, and they used to get tax-free income of crores of rupees. Hundreds of crores of rupees income has gone out of India without payment of tax. Suddenly, the government realized that this is a tax planning channel which was being used to use Mauritius. They immediately plugged that loophole and they amended that treaty, and they brought in this LOB clause, and there is one more clause, principal purpose test has been introduced in this Mauritius treaty. They have introduced in other treaties also, but this Mauritius particularly has been introduced. Now, what is required? You cannot have a dummy or a dormant company operating in Mauritius. You have to have an operative company. And if there is an operative company, then only you will get the benefit of this treaty. Otherwise, you will not get benefit of this treaty. So they have plugged that loophole and they have removed this lacuna in that. And so you now you have to have a sizable office. You have to have expenditure. They have also defined the expenditure around 1.5 million Mauritian dollar or 2.7 million rupees. You should have expenditure in the previous year. Then only you qualify for this benefit. Otherwise, you will not qualify. In Singapore, it is $2 lakh or around 5 million Indian rupees. You should have the business, activities in that company. Otherwise, it is considered as a dummy company and you will not get this benefit. So now they have plugged this loophole. Similarly, there's a principal purpose case that a principal purpose should be for business, operating business, and it should not be just a investment vehicle, and it should not be just a dummy transaction. So that is where the treaty was amended. Business income, as I mentioned to you, permanent establishment is important. If there is a permanent establishment, then the taxability is in India. Otherwise, taxability is in the foreign country. Capital gains, as I mentioned to you, where the property is situated. We already know a very famous Vodafone case, what happened. And there was, of course, after that, amendments to the law, which happened subsequently. We are all aware. Now we look at the inbound investments which you are eligible to make in inbound investments in the Indian companies. There are various vehicles in which inbound investments can be made. On one side, which is the debt instrument, is the ECB. Foreign companies can give debt to an Indian company. Of course, there are conditions. And an Indian entity can borrow, first of all, from a foreign bank. It is allowed, or foreign financial institution allowed. There are caps of the ceilings and amounts and the interest and all that. There is a cap. As far as the non-banking sector is concerned, there are restrictions. You cannot borrow from any company over there, except if that company is your shareholder. Yes, then you can borrow from that shareholder, or that company is suppose it's not a shareholder, but it is a common having a common shareholder with the common ownership with the shareholder. For example, suppose there is the company X in let's say a foreign country, who is your shareholder, and there is a company Y in the foreign country which is not your shareholder, but the company Y and company X is the same owners. Then company Y can also lend money to the Indian company under ECB route. Now, why would person take an ECB? Because the rates are cheaper in foreign countries. It is on a LIBOR base rather than we pay around 14-15% rate of interest there. Those rates are around 4-5%. So we get a lower rate. But then, of course, the exchange risk is very high. So if you feel that the dollar is going to be stable and not going to, or if you do the cover hedging, and if you feel that still my cost is 8-9%, I'm saving money, then probably ECB is better. Otherwise, a local borrowing would be much better. Trade credit, if you can take a supplier credit, is also available. But here, very interesting thing which RBI has regulated, that you cannot keep your trade credits or any liability outstanding for more than 1 lakh when it is due. That means you cannot say that I will not pay more than after more than 1 year. That is, you need to go to RBI to take their approval, because it spoils the image of the country, because the country's image is very important. Today, whatever these investments we are seeing, we seeing all these inflows are coming in. It is because we have maintained that level of image of the country that yes, we can honor our commitments. And because of that only, the foreign investors are having confidence in our country's this. So then money comes very easily in our country. So if once we break that, then we will have a difficulty getting more funds into. Like for example, there are certain countries where people don't even touch their bank LCs also. They wanted to be confirmed with the European banks to be a confirming party. Whereas in India, we don't have that. We have a very sound banking system. We have a sound regulations, and our economy is stable. Our political situation is stable. Because of that, the investment, the environment is very very hopeful and potential. On the other side, on the non-debt side, then there is a foreign direct investment which can come in. That is by way of investment into capital, equity capital or preference capital or whatever, convertible debentures that can come in. Then there is a foreign portfolio investment which are pure foreign entities can invest into the stock markets of Indian stock markets. Then a non-resident and OCI can also invest in the stock markets in India on a repatriation basis. There are some investments NRI and OCI can do on a non-repatriation basis in LLP or a partnership firm. That is not allowed to be repatriated. Whatever capital is there, that money will remain in India. It cannot be repatriated outside India. Whatever profits you earn in India, it cannot be repatriated outside India. Investments in LLP is now permitted. Earlier, it was not permitted. They have liberalized that also. A foreign venture capital investor can invest into India so that our Indian economy market can be boosted. Investment by person resident outside India in an investment vehicle. It could be notes or whatever vehicle is available. It can be REITs. All these things are allowed to be invested by a foreign investor. Investment in Indian depository receipts (IDR) is also allowed now under the FEMA. Foreign direct investment scheme we will take up because that is the most popular scheme in the vehicle under which a lot of money is coming into India. Eligible entities where investment can be made is companies are private limited companies or a public limited companies can get foreign direct investment from any company outside India who can put the money into the Indian capital. Now, what are the mode of remittances? It has to be through banking channel. It has to be through inward remittance from that bank, and there has to be an FIRC, which should state very clearly that it is for investment in the foreign investment scheme. There are, of course, sectoral caps. I mean, there are certain prohibited sectors. We cannot do it like real estate and TDR. Real estate doesn't mean development projects. Real estate means trading in property because property market is volatile. They don't want any speculation in property market from the foreign players because India is the only country where the property market is very volatile and appreciates, whereas in the foreign countries, there's not much of a volatility in the property market. So in India, they don't want to have a speculation in the property market from the foreign investors. So they don't permit any investments in those companies which are trading in properties or TDR. Yes, if a company is doing a project, real estate project, and if there is a investment, of course, there are conditions. We have to comply with those conditions, and a foreign investor can invest into those projects. Now, what kind of type of instruments and instruments we will discuss? Valuation norms which are applicable, which a chartered accountant will have to certify as a valuer. Time limits for compliances are there. You have to comply within those time limits. Processes and compliances we will discuss. So now this is the next our top point of topic is what are the eligible entities? As I mentioned to you, company registered under a Companies Act. LLP under certain circumstances are permitted. And mode of remittance, as I mentioned to you, is by inward remittance to banking channels. There is no other mode. What are the prohibited sectors? Lottery business, gambling, trading in transferable development rights, manufacturing of cigars and all those things not allowed. Needy companies not allowed. Real estate business, but real estate business does not mean development of projects. It was only for trading of shares. Sectors not open to private sector. There are so many atomic energy and railway operation. Now, just today only I saw one new notification which says that the satellites they opened up, which was not earlier allowed. Parts of satellites, if somebody is manufacturing, there also they've allowed investment in by foreign. Why they are not allowing in certain sectors is because those are very critical sectors and they want to keep the control in the Indian hands and not in the foreign hands. So to maintain the India's sovereignty. FDI sectoral caps, yes, there are two routes. One is the automatic route and one is the approval route. If it is within the sectoral cap, then there is no need for approval route. But if it is not within the sectoral cap and if it is going outside the sectoral cap, yes, you need to have an approval route for RBI and or FIPP, and only then you are allowed to invest. Or if, of course, under a prohibited sector, and even approval route is not applicable. Only in those situations where you are not meeting the criteria and you want to go to the RBI may consider depending on the facts and the situation of the cases. So, but automatic route is a very easy route where you comply, and then there is no need for any RBI approval, and your particular FEMA compliance is done. So most of the sectors are eligible for 100% investments in companies' equity. Wherever there is a sector, the same are defined, and then there are conditions attached to each of the sectors. Okay, which even if it is 100%, then there are conditions. For example, if there is a real estate sector, if it is a projects, there also there is a minimum area that the project should be of that much size. It cannot be a very small project. You can't have a foreign investment for a very small size. 50,000 square meter is what they want. So if that again, then there is a 3-year period. If money should the project should complete within some time period. Otherwise, it cannot be open-ended. All these conditions you are supposed to comply. Investment not falling within this category will require prior approval. It is not post-approval. So before the money comes into the Indian company, they have to take a RBI approval. Now, what kind of instruments under which this particular thing is allowed? Equity shares is a very simple thing. Compulsorily convertible preferential. Initially, when the FEMA, this FDI was introduced, even the optionally convertible preference shares, redeemable preferences were allowed. But then that actually categorizes a debt. You know, we all know in India, redeemable preference shares is categorized as a debt and not as a equity. So they have not allowed any optionally convertible preference shares or redeemable preference shares. Only compulsorily convertible preference shares are allowed. Even similarly, compulsorily convertible debentures, because although debentures would be considered as a debt, but in India also compulsorily convertible debenture is considered as a capital, because there is no question of money going out, because there is no option of liquidation. It is only that it has to be converted into equity at a later date. So that is permitted under this FDI. Debt instruments like redeemable debentures or preferences are not allowed. Now, what are the pricing norms? This is again very interesting. You have to be very careful how do you design your pricing, because as far as FEMA is concerned, it says that you cannot the pricing, the valuation of the shares which you are allotting to the person resident outside India should not be lower than what you have worked out as per the DCF method with the valuation norms as per the guidelines given under the FEMA. Now, that chartered accountant has to give a valuation based on whatever the DCF method. And suppose, for example, he has worked out 150 rupees as the value. The shares cannot be allotted lower than 150. It can be allotted at a higher price, but not lower than 150. Now, you have to also look at Income Tax Act. Income Tax Act, Section 5627B. 5627B earlier gave exemption to non-resident investment in an Indian company, but that exemption now has been removed. Recently, there has been amendment. So now, even this particular investment which comes under any company will also have to be examined from 5627B. So if the money, the valuation is above the value which has been, it will attract tax in the hands of the Indian company. So we have to see where that means it should be exactly equal to the value which is worked out under the DCF method, and it cannot be higher. Although FEMA may permit you to allot at a higher price, but income tax will then tax you. So then you should be willing to pay the tax on that. Now, here, as far as if the listed company, then you have to go as per the whatever the listing valuation is there as per the listed market price. And if there is a valuation as per internationally accepted pricing methodology, which DCF is considered as a internationally accepted pricing methodology. Now, again, this time limit. Now, when the money has to come into the company, Now, this is very important. The money should come in under the banking channels. KYC has to be done by the bank, remitting bank, in the favor of the Indian bank, so that they know that this particular customer who is remitting, the client who is remitting, is known to that bank. So that KYC norm, without that KYC form, that remittance will be of no use. Then once you have got the money, within 60 days, you're supposed to allot the shares. You cannot delay more than beyond 60 days. And once you receive the money within, and you have allotted the share, within 30 days of allotment, you are supposed to file online FCGPR form. And that online form has to be done. Once you file that form, the RBI acknowledges this form. Once it is done, the process is complete. Now FCTR is in respect of transfer. That means once you have got the money, the shares are allotted. Now that person who is a shareholder, foreign shareholder, who wants to transfer the share later on to any, maybe to a local person in India, or maybe to our, suppose if it is a transfer between a non-resident to non-resident, no FCTRS is required. But if there is a transfer between a resident to non-resident or a non-resident to resident, then yes, FCTRS is required. Now suppose this investment can be of two types. One, either the money comes into the company as a subscription, or it can come to the shareholders by acquiring the shares. Even that is allowed. So if that is happening, then FCTRS is to be filed and not FCGPR. And then FCTRS basically again has the same valuation norm, same requirement. And again, FCTRS has to be filed before to the EDI Bank online. The filing is to be filed through RBI portal online. Then there is that particular portal is forms.rbi.org.in. First, you have to create a user ID, entity user and business user. Create those users on the RBI portal. Then after doing that, then you will get a particular login. Once you get that, then you upload those forms. These forms will be with the KYC, with the valuation report, the FIRC, all these things you are supposed to submit. Even the share certificate, a lot of resolutions, whatever has happened, and all that you submit along with the FCGPR form. And once it is submitted, RBI will acknowledge it. There is no question of approval. It is only acknowledgement. Once it is acknowledged, then your entire process of FCGPR or the investment is complete. And you have complied with the FEMA. And when you want to sell those shares, these shares, the investor wants to sell this share, this acknowledgement is very important, because without that acknowledgement, they will not be in a position to transfer those shares to anybody else. And now, suppose now this online process has come very recently. Earlier, there was a manual process which we had to go through the AD Bank. We had to submit to the AD Bank. AD Bank would submit to the RBI. But that in that situation, RBI used to issue a letter of acknowledgement. Yes, we have taken this particular investment on record. Now, in many cases, these particular letters were not received. And when subsequently the investor wants to sell the share, then there is a problem. They have to go to the RBI, they have to collect those letters first, and then only this particular shares can be transferred. And this letter may not have been issued, probably because there was some query from the RBI on those documents. And if those queries were not replied, these letters would not have been issued. So we have to ensure that these letters are collected in case of manual filing earlier. Of course, now with this online filing, there is no question. We have an acknowledgement in our portal. It doesn't take much time. It is a very simple process. How we do income tax return, it is a similar process. So it is not a very difficult situation. Now, these are the different kinds of forms which are available. FCGPR, which I mentioned, FCTRS, LLP1, LLP2, which we filed, which are for the different kinds of instruments that, as I mentioned to you, different kinds of instruments, different kinds of forms. For a commercial convertible notes, there is a separate form. ESOP, if there is an ESOP given to the foreign entity, to an Indian company, that again there is a separate form. Then there is a downstream investment is there, again there is a separate form. Then there is a depository receipt which is there, again that is a separate form. So there are different forms for different types of investments. FCGPR is relating to the shares or the convertible debentures or convertible preference shares. And FCTR is in respect of transfer of shares and not in respect of allotment of shares. FCGPR is only in respect of allotment of shares. Now this, we already discussed what we are required to submit, so I'm not again going into it. Now FCTRS filing. FCTRS again is the similar process. You have to file KYC of the person who is either sold or acquired the shares. Relevant regulatory approvals, which is required, whether it is applicable. Consent letter from both that yes, I'm agreeing to buy and he's agreeing to sell. All those consent letters we're supposed to submit. Non-resident declaration that yes, I'm eligible to buy these shares, or that person is eligible to sell the give in that declaration. And valuation certificate again is applicable, because again valuation is has to be as per the same procedure as in case of a resident selling the shares to non-resident. Again, it cannot be at a price lower than the valuation report. And if he's buying, suppose if a non-resident is buying from a resident is buying from a non-resident, then it cannot be higher than the valuation. So it's other way. When one person is buying, because the resident is paying money to him, so no money can go outside India, which is higher than the valuation. So that is a very simple it is a common sense. The principle is very simple. So this is again, what are the forms required? Share transfer form is required, SH4, valuation certificate, non-resident declaration. In case of sale, as I mentioned to you, that sold other attachment. Outward remittance certificate, you have to give. No objections. Tax certificate. In case of there is a TDS, you have to see 15CA, 15CB has to be filed. Government approval if applicable. If that's not applicable, then it is not required. So these are all the requirements for FCTRS. Now let us go into the situation where we discuss is about the inbound investment. That is an Indian company who is receiving the foreign investment. Now here it's an Indian company which is setting up a company outside India, maybe investing outside India in a subsidiary, in a wholly owned subsidiary, or a joint venture, or a associate outside India. It is allowed. Now it can remit outside India to the extent of almost 400% of its net worth. Whatever a company's net worth on the last audited balance sheet, we can remit up to 400% for any investment outside India. Now it is an aggregate. Now suppose if the company has made 5 investments, all put together cannot exceed 400% of its net worth. So now what does it constitute? What is that amount? 400% will be on what basis? It will be on all financial commitment. Financial commitment will also include pledge, guarantee. Suppose an Indian company has given a guarantee to the foreign entity for borrowing outside India. That also will be part of the 400% limit. Suppose, for example, it has already exceeded 400%. I mean, it has crossed 300% in investment. It can give guarantee only to the extent of 100%. It cannot give guarantee to the extent of more than 100%. So we cannot cross 400% in terms of totality, whatever, either by way of commitment in terms of investments or by way of guarantees. In banned investment, again, real estate trading and ADR trading outside India is not permitted. So we cannot invest into those entities which are doing this kind of business. Proprietorships cannot invest. There are certain regulations under which it can invest, but I am not getting into it. It is a very limited purpose. We will only deal with the generally, which is popular route. Again, there is an automatic and approval route. Whatever is within the norms, you can go under automatic route. Just go to the AD Bank, go with all the certification, go with this form, and AD Bank will allow you to remit money outside India. No questions asked. Now, you don't need RBI prior approval. All these forms will be post facto filed, sent to the RBI. And if there are any lacunas or if there is any non-compliances, RBI may raise a query later on. So you have to ensure that whatever is the compliances have to be done perfectly well, because once you have remitted money outside India, your hands are tight now. Now, if the RBI finds out a fault that yes, you are not allowed to remit and you have remitted, then you are into big trouble. Then penalty and all those provisions will be applicable. Now, here this 400% of net worth. What is this net worth? This is again very interesting. Now it says that whatever audited balance sheet should not be more than 18 months have elapsed. For example, suppose today you want to remit. Let's say you want to remit today. Now your audited balance sheet of March 24 is not ready, but March 23 audited balance sheet is available. Yes, you can remit. 18 months have not passed from that March 23. So up to September 24, you can utilize March 23 audited balance sheet. But by September, I'm sure you will have March 24, because there is a time limit up to within 6 months. You are supposed to get March 24. So definitely March 24 will come in before September. And at that stage, you will be in a position to provide that March 24 figures. So in that situation, you cannot exceed 18 months period. net worth, what does it include? Now, what is the net worth? Is a very interesting question. Now, that net worth is defined as per Section 2 of the Companies Act. Now, initially it was not there. It has been defined as to capital and everything, but now they have changed the provision. It says as per Section 2 of the Companies Act. And if you refer to the Section 2 of the Companies Act, it says what is as per the audited financial statement. What is the net worth as per audited financial statement? Now, the audited financial statement is basically, if you see in Ind AS or accounting standard, there is a different line. For example, if you see Ind AS, the net worth does not include preference shares. Redeemable preference shares will not be part of the net worth in case of a Ind AS balance sheet. Suppose if that entity is following Ind AS, then the net worth will not contain redeemable preference shares. But when it comes to AS balance sheet, redeemable preference shares would be part of the net worth, because as far as accounting standard is concerned, that that particular provisions are not applicable, and hence preference shares is considered as capital. So there is a dichotomy here. In both two scenarios, different scenarios, the net worth changes. But then we have to go as per what is the audited financial statement. Whatever is applicable to that company, we have to comply. Now, there is another one restriction. ODI, he cannot invest in a country which are under non-cooperative mode. But you have to first check. Then there is a site called FATF. It is a Financial Action Task Force, which is a site, the global site, which lists out various countries which are non-compliant. They are encouraging money laundering or terrorism or whatever, and because of that, this world over they have been banned. That yes, nobody will either invest in that and those countries, because they are not cooperative. They are not cooperating. They are not opening their books. They're not allowing access to their records. Whatever may be the reason, but there is a site which RBI has prescribed that yes, you have to go to the site, and if that particular country is listed on that site under a black or a gray list, then in that situation you have to you cannot invest into that company. Now, so in this you have to verify the FATF. NOC is required from relevant agencies. Now, suppose tomorrow this entity, Indian entity, is an NPA. Then you need a bank NOC, NOC from the bank, that whether we can whether he can invest outside India. The reason is very simple. You're in one hand, he's not in a position to pay your bankers. He is an NPA. He's a defaulter, and here he is investing outside India. So the bank may not permit. Bank may not give NOC, and then in that situation, he will not be able to invest in outside India. So this brings about some amount of financial discipline, that a person should be disciplined enough to be able to invest outside India. And if it is under investigation by any agencies like ED or a CBI or anybody, then you need an NOC from that. It's not that you cannot invest. You need an NOC. If they give NOC, then yes. But I'm sure you will not get NOC if you are under investigation from any of these agencies. Even RBI is investigating your case, then you will not get NOC from there. Share certificate has to be received within the 60 days from 6 months. 6 months from the date you have invested. Within that 6 months, you are supposed to collect the share certificate from the foreign company and submit it to the bank, AD bank. And if you have not submitted, then again, then there is a violation. In case of a liquidation, again, then there is a funds have to be remitted back to India. Now, what is an ODI process? You have to create a UIN before remitting, file an ODI form with the AD bank. There is an ODI form which you have to file. ODI form in the ODI form, there are various schedules, and Schedule E is to be certified by the statutory auditor, not any chartered accountant, statutory auditor of that company. And in that, he has to certify that whether all the compliances, what is required for ODI is done, including this 400%, whether it is within the net worth. And the ODI has got so many such conditions like this, whether there is no NOC, defaulter hai ke nahi, and whether there is any notices from any proceedings are going on with any agencies. All that the auditor is to see, and then only certify Form E that yes, he is eligible for remitting outside India. Otherwise, he should not certify. And he should also work out whether it is within the norms, within that 400% limit, whether the money is going out. Whether again this FATF also is supposed to see, and documentation has to be proper. the bank will approve this ODI, Form A2 is to be filed, and then the remittance can be sent. Now, every year till that ODI is investment is there outside India, the company has to, the entity has to file one annual performance report through AD Bank, through an AD Bank with the RBI. APR is we file in every year. For example, suppose if the entity has a calendar year or a financial year. So for calendar year 23, the due date of that APR filing will be 31st December 24. For a financial year ending March 24, again the due date will be same, 31st March 24. So the next December, which is December end, 31st December is the due date for filing the APR. One has to file the APR. If you do not file APR, then there are other repercussions. Then subsequent remittance may not be allowed. All those problems will come because you have not complied with the earlier provisions. In case of multiple investors from India, suppose in one entity in outside India, there are 4 Indian companies who have invested. So any one highest investor who has got the highest investment will file APR. And in case of equal, they will file it jointly. APR, as I said, is to be certified by a statutory auditor. So even APR is to be certified. Now, what does APR contain? APR contains details of that foreign entities, net worth, its profit and loss account, its share capital, net worth, profit and loss of that foreign entity you are supposed to report. Now, here there is a very interesting point. Here it says, earlier, before about a few years, that ODI regulations were different. Now ODI regulations have been amended drastically. Before the amendment, suppose that foreign company did not have any requirement of audit in that host country. Suppose, for example, in US, there is companies in US, certain smaller companies, they don't require audit. It's not compulsory. So only larger companies require audit. So those unaudited accounts, management signed accounts were being submitted to the Indian entity. Now, that were being submitted under the APR, it was allowed. And the auditor would say that it is under the host country, the audit is not mandatory, and hence unaudited accounts were submitted. It's fine. But now with the amendment, there is a change. What is the change? It says if the Indian entity has a control in that foreign entity, then irrespective whether the host country requires audit or not required, the foreign entity will have to get their account audited. You cannot submit unaudited accounts. Now, here again, what is the control definition? Control definition is 10% of the shares. We all know control means more than 50%. Control means you are owning that company, you are controlling this company. Your 10% is the threshold limit for the control. Of course, the wording of that definition control is little loosely worded. It says, having the authority to appoint directors or having a government of policies and all that through an agreement or through any instrument. And then again, here the percentage is 10%. So we were talking to certain people, in the department and finding out as to how do you, what connection, whether that 10% is important or that controlling the board of directors or policies are important. So he says that generally when you are investing out of India, you are not investing only as an investor. You are having some control. You are having some influence. You cannot say that you don't have a control when you are putting huge amount of money. So there is a little dichotomy. So in most of the, wherever you have got 10% or more shareholding, you should insist on a audited account, irrespective whether the host company, the host country requires audit or not. And then only you call for the audited accounts and submit along with the APR. Otherwise, your APR will remain pending. So now we'll just quickly, because time is running short, we have got about another 15 minutes or 20 minutes. So liberalized remittance scheme, which is very interesting. A resident Indian can remit up to $250,000 per financial year per person. Now, this is applicable to adult. Minors cannot remit. An adult can remit up to $250,000. And what for they can remit? They can acquire property outside India. They can buy shares of listed companies outside India. They can open bank account outside India, deposit that money, and from there they can buy a property. It's also allowed. So what was not permitted earlier for a resident to open bank account is now being officially permitted under the liberalized remittance scheme. But yes, one must not forget, once he's a resident, and if he's a resident also in the Indian Income Tax Act, as per Indian Income Tax Act, then there is a huge amount of disclosures required under the income tax return. and under the Foreign Bill Act. Here, the disclosure is that all the foreign assets, foreign bank accounts, suppose if it is a signatory to that foreign account, that also is required to be disclosed in this return of income, and non-disclosure is a huge violation in an income tax act. 10 lakh rupees per return per year is the penalty, and if you have escaped any income out of that which has been escaped, prosecution is being initiated. So it is a very serious matter. So liberalization is there. You have got so many privileges, but a lot of obligations are also there. You have to ensure that you comply with those obligations also. Now, there is another return, which the moment you have an inbound investment or you have an outbound investment, you are required compulsorily to file a foreign liabilities and asset return every year. And that is, the due date is 15th of July. That means now 15th July is coming in. So up to 31st March, whatever is your, as on 31st March, whatever is your foreign assets and liabilities, you are supposed to report in an FLA return on 15th of July to the RBI. Again, this site is online. You have to submit it online to a FLAIR portal. There is a FLAIR.RBI portal, and you are supposed to file it online. Again, login, everything is like how we do income tax. You do login, you get an OTP, you then file this particular form. Now, this form has got 5 sections. Section 1 is the basic information about the entity identification. Now, this is to be filed by the resident local entity who has got inbound investment or who has made outbound investment, not by the non-resident person. It is only by the Indian resident entity. Financial results of the Indian entity first has to be given in the section 2, where his net worth, his profits, sales, purchase, employees, all this thing has to be given in the section 2 about the Indian entity. Okay. And financial liabilities have to be given in respect of section 3 in respect of all investments made in India. That is a liability. See, even if it is a capital, it is a liability, because tomorrow that investor is going to take the money out. So for the country as a whole, it is a liability. You might think it is a capital, but it is not a capital. It is a liability, because the money has to go out. So investment, the RBI wants to know as a whole, how much is our liability, how much are our assets, how much have we invested outside India, how much is our liability in terms of money received in India. So this is the return which gives the RBI the control and details as to how much money has come into India and how much money is owed outside India and how much money is due from outside India. Now, when you file this for financial liabilities, you don't have to restrict only to those capital, share capital. Then you also have to give any trade creditors which are due. Suppose you have during this year, the company has done any imports of goods for which the money is out payable, even on 31st March, that also has to be reported. Now, suppose any entity has not done any inbound investment, has not done any outbound investment, but only as creditors or any debtors, any exports debtors, they don't have to file FLA. Only when you have inbound and outbound investments, then only this FLA is to file. And when you file FLA, then you have to give this particular about the creditors and debtors. Otherwise, creditors, debtors are not required for any other entities who are only doing trading and export of goods. They don't need to file this FLA. Then there is a form, section 3, which talks about, section 4 talks about financial asset. That means any money which has been, invested by the Indian entity outside India. Now, again, this is based on the value of the net worth of that entity. Even similarly, when the money is coming to India, you have to work out what is the value of this company in terms of investments. Now, variation report. The section 5 is automatically calculate variation report between the what last year you filed and what this year you filed. So if there is any variation, you are supposed to explain also why there is a big variation. You are supposed to give reason. Like how in our tax audit is supposed to give ratio analysis variation, here you are supposed to give some variation. Now, export of goods and services are very simple. Person can export goods, receive money. There is a time limit of 9 months to recover their export proceeds. Now, here there is a special provision relating to export of software. If you are exporting software, then you have to compulsorily register with STPI in India. There are software technology parks of India. You have to register with them. And once you have registered, you are supposed to send your invoices before you send to the customer to this STPI. They will vet it, whether this is as per arm's length, whether it is as per market price, what you are billing to the customer is as per market price, and then only they will certify. Because in case of export of goods, then there is a benchmarking by the customs. But when it comes to services and software, then there is no benchmarking. So this STPI does the benchmarking whether whatever software you are supplying is it as per market price or no. And if there is no market price, they may not approve your invoice, and you will have to correct those invoices. So then once it is done, then there are quarterly returns also to be filed as to how much invoices you have raised, how much money you have realized, and whether it is within time limit. All those things you're supposed to report in your quarterly returns. For export of goods, as I mentioned, the shipping evidence has to be given to the AD Bank, and AD Bank then monitors whether the money for that particular thing has been received within this timeline, within 9 months. And if it is not, then you're supposed to seek an extension. And AD Bank generally gives extension, but you have to give reasoning as to why there is a delay, and they generally give. In case of a write-off, if there are certain percentages of, if you're exporter, then there is certain percentage which you can write off over a period of time in case if your bad debts are not recoverable. And in case of delay, you have to apply for an extension. Now we come to another very serious and a very interesting provision for compounding and penalties. Now, when having given all this liberalization, all these facilities, okay, you can do it whatever you want without RBI approval. Earlier, it was all approval regime. Now it is all automatic regime. Substantially, it has come into automatic regime. Then they have to have some penalty mechanism, some control mechanism. Otherwise, there might be misuse of certain provisions. In order to avoid those misuse of this provision, then FEMA has brought out a very serious penal provision, which are financial penalties. If there is a default in FEMA for non-compliance, suppose, for example, of course, now there are two types of penalty. One is the late filing fee. Now in our even MCA we have late filing fee. If you file a form late, then you pay additional fee. Similarly in RBI, suppose for example FCGDR is delayed, then you pay LSF, late submission fee, and then don't you need to pay any penalty or compounding or anything. The LSF is enough, and there are nominal fee. It is not very high, 5,000, 10,000 depending on the period of default. You pay this fee, and that default is condoned. Now, if the default continues for 3 years, then LSF cannot come in. Either it has to be compounding or it has to go for penalty. Now, what is the difference between compounding and penalty? If RBI or AD Bank on its own issues a notice before you inform RBI or before you go to the RBI with a folded hands, and if RBI detects an error and issues a notice to you, and then it is penalty. But even before RBI writes any notice or issues any notice, you realize that yes, there was a default, there's a mistake which has happened and you have defaulted in particular thing. You have remitted money and you were not eligible. You have exceeded 400% limit and you have remitted money. Somehow there was a mistake, some mistake in calculation. You realize this mistake after remittance. You immediately approach RBI. Look, there was with a folded hand. Look, there was a mistake. RBI mechanism permit you to do compounding. And in that, compounding of offense is much more cheaper compared to the penalty. Compounding of offense may be around 5 to 10% of the amount involved. But when it comes to penalty, it is 3 times the amount involved. Suppose if you have remitted $1 million, you can imagine 8 crore rupees, and you can imagine the penalty of almost about 24 crores you will be paying. Not only that, if the default is continuing, then there is a 5,000 rupees per day default till the default is mitigated. So it is a very serious offense and huge amount of cost involved. And not only that, it applies to both. Now, of course, person resident outside India may not be impacted, but when there are two people who are non-resident Indian and resident, yes, then non-resident Indian definitely will be liable because he can come to India, he will be asked to pay this penalty. But if it's a pure foreign citizen, may escape because who will collect from him? If the amount cannot be quantifiable, then it will be 2 lakh rupees. So that they have described. But if in most of the cases, these are financial transactions. So if any amount which has been remitted, which was not supposed to be remitted, or if any amount is brought into India, which was not allowed to be brought into India, in both the situations, penalty will be attracted at a rate of 3 times the amount involved, and continuing penalty will be applicable till the time the default continues, and the RBI will levy this penalty. And if the payment of the penalty is not made within 90 days, then they can initiate prosecution. So till that time, there is no prosecution. It is only financial thing, civil thing. So then there is no issue. But the moment you have crossed, you have not paid penalty for 90 days, you have defaulted even in paying of penalty, then prosecution proceedings will be initiated, and then there is no escape. For defaults of assets held, now there is another section 37A, which says okay, for defaults of the assets which are held outside India beyond limits. Suppose, for example, you are allowed to remit $250,000 per year, financial year. But sometimes the RBI finds out to some source that you are holding more than $1 million in Swiss bank or some another bank in outside India, and you are eligible only to remit up to 250,000 per financial year, which you have remitted. But your assets are more than what you have remitted, and that there is no source which was explained for that additional remittance. Then, and in that situation, there is a 3 times penalty and prosecution, because that is what the government is trying to control any assets held outside India which are not from the correct source, proper source. So that is again a very serious matter. In case the entity approached the RBI through AD Bank for any default suo motu, as I mentioned to you, compounding application can be made. RBI at its discretion, there will be a hearing. Chartered accountant can represent. That is our opportunity as a chartered accountant to represent before the RBI, explain what are the reasons why this default, why this mistake happened, why this error happened. And if the RBI is convinced that yes, it is a genuine bona fide error, then 5 to 10%, depending on the case-to-case basis, even it could be 15%. I'm not saying there is no benchmark. There is nowhere it says 5 to 10%. Generally, we have seen the practice. That is how compounding fee has been levied. So it is around 5 to 10% on a case-to-case basis, the RBI levies. Now, as I already told you, FEMA is monitored by RBI and AD Bank, but it has powers are controlled by the Enforcement Directorate. And you know how Enforcement Directorate has got such a huge powers that they can arrest, even when they issue summons. When you go for a summons, it is possible that you will be detained. They have a powers to arrest you. So these are the negative sides of the thing. But then they have given you a lot of liberties, a lot of privileges. One has to apply those privileges and the benefits in a very logical manner, very systematic manner, bona fide manner, and then there is no issue. But if somebody tries to apply it on a malefied intention, with a malefied intention, or with any manipulative intentions or money laundering processes, then yes, then the law will take its own course, and then you can't help. In conclusion, as I said, FEMA has liberalized the transactions in foreign exchange considerably. As a professional, we have been entrusted with a responsibility to ensure compliance with the FEMA before certification, as our certification is the key on which the AD gives approval. I have seen those AD banks notings to the RBI saying that, look, based on the Chartered Accountant certificate, Statutory Auditor certificate, we are considering this transaction okay, and within the provisions of law, and we have allowed remittance. So the AD Bank is not going to apply mine. AD Bank says based on whatever CA is certified, I am going by that. So lot of onus, lot of responsibility on our professionals. We should understand the law. It's a good opportunity for us to practice, but at the same time, there has to be a responsibility. We have to follow our auditing standards, do proper documentation before certifying, keep our paperwork thorough. You should have our documentation in file in place, so that tomorrow if there is any query from RBI, we should be able to justify how we certified a particular figure. With this authority, a great responsibility is on our shoulders. So we have to exercise this due restraint on this, and ensure that our responsibility is honored, and our name is maintained, and our dignity is maintained as a chartered accountant. With this, I think I've come to the end of my presentation. So if there are any questions, I'll be free to answer.
Can I read the questions, or you can see the
Yes.
Q&A tabs?
I'm not able to see those questions. If you can.
Okay, can I read them?
Yes, sir. Yes, ma'am.
Am I audible, sir?
Yeah, you are audible.
Anyone from the technical team? Am I audible? Yeah. So the first question is, the POI origin settled in Canada for more than 20 years, wish to sell immovable property and thereafter want to remit the funds. So what is the TDS provision and compliance under FEMA?
It's very simple. There is no such compliance. If is a PYN is settled in Canada, if that property is in India, he can first of all sell that property, no harm. Whatever is the taxes, he has to pay the taxes in India, applicable taxes. Now we have to see how much he remitted from outside India, from Canada when he bought this property. To that extent, he can remit as it is. There is no issue. As far as the profits which he earned out of that, then will go under 1 million scheme. So if it goes above 1 million scheme, then he cannot do it in 1 year. He has to wait. He has to complete that within the one financial year up to 1 million scheme. So of course, net of tax, there is no form except 15 CA, 15 CB. There is no intimation to RBI or there is nothing to be submitted. He can straight away remit money outside India, subject to of course these limits and the tax payments and the conditions.
Thank you, sir. On behalf of the participant, can a non-resident receive security deposit for letting out his or her flat to a resident Indian? Is there any compliance requirement relating thereto?
No, I don't think there is any compliance on that. A non-resident is having a flat in India, and if he has received a security deposit in terms of this renting out a property to a resident in India, there is no need for any compliance. It is very simple, allowed.
Okay.
It is not
Can
considered
a
as a
non-
borrowing.
Okay. Okay. Noted. So can a non-resident Indian invest in Provident Fund account which was opened before the person became NRI?
I mean, subsequent investments.
No, the account was opened before he became NRI.
Yeah.
Subsequently, can he invest in that account?
Now, see, there are certain investments which are allowed on a repatriation base. Yes, investment he can do, but whether it is repatriable or non-repatriable is a question mark. PPF, as I understand, to my knowledge, it is repatriable, but it can be under 1 million.
Oh,
Because
under
in
1
any case,
million.
PPF is not taxable. So whatever interest you receive, it is taxable.
With the consultancy service regarding any product registration from foreign company will cover under fee for technical services?
Yeah, very interesting, very interesting. It is, as I understand, it will be if it is a registration fee for a license or for any product. Basically, we have dealt with the situation for a client's place. There is a little ambiguity whether it is a business income or it is a technical fee. It can qualify as a business income because there is no technical involved. It is more of a business nature. But there are some judgments which in income tax which says it is a technical fee. So there are two sides of a coin. So it is better in if there is a TDS to be deducted, it is better to deduct.
Okay.
Withholding tax will need to be deducted.
Okay. Thank you, sir.
And depending on the DTA.
How can one comply with transfer of funds via digital mode, that is USD to abroad and vice versa?
No, it's not allowed. See, as far as we had a major issue in one of our client. What had happened? I'll give you an example. We can't do digital mode. You can't send it by GPay or you can't send it by credit card or anything like that. It has to come through the normal banking channel. That means you have to send RTGS or whatever the route to the bank. You have to remit this money to the bank, and your foreign bank has to remit to our Indian bank. Now, I will give you an example. What happened? There was one Indian company had established one subsidiary in the US for some software work. When the director of that company went, then he had to take some electricity charges over there. So what he did is a shortcut. He used his credit card and he made the payment. And then later on, that company reimbursed his charges to this director. Later on, this AD bank objected, okay, you can't do all this because you had no business using your credit card. This is an ODI. So now you are funding that your foreign subsidiary. You have to remit it through the ODI to the AD bank. You have to file that ODI form. If it's the working capital, fine. The money is going for working capital, but it has to go through the banking channels. You had no business of using your credit card or any GPay or any such online methodology to remit. But you can't even use your online transaction. You have to approach the AD bank, file the necessary forms. AD bank will vet. do all that process, and then only the money will be remitted. Otherwise, because you have to see the limits and all that, everything is to be seen by the AD bank. You, by using credit card or by using online payment, you have bypassed all that, which you can't. So there's a major issue, and then we have to pay huge penalty for a small amount.
Okay, sir. So many questions. Everyone has really taken so many things, but then this topic is such that everyone has
Yes,
some
I
queries
understand.
at some point of time.
Yes.
Sir, if a person has invested in his savings in mutual funds while he was resident,
Yes.
and now his status is of non-resident for both
Correct.
income tax and FEMA. So
Correct.
now he wants to repatriate money from redemption of those mutual funds.
Correct.
So can he do it? And is
1
there
million.
any restrictions from
No,
FEMA
1
and
million
RBI?
scheme. 1 million scheme. If he's
Okay.
if he has become a non-resident later on, and if investment was made out earlier when he was a resident, no issues. He can continue to hold it, and when he sells it, up to 1 million scheme, subject to payment of taxes, he can remit out.
Agricultural land that was bought during resident in India,
Yes.
after becoming NRI, can he sell the land and repatriate?
No, he cannot repatriate. He can only sell to a resident. He cannot sell it to a non-resident.
Okay.
He can sell it
and
to a resident, but he cannot repatriate. Neither he can repatriate nor he can sell to a non-resident.
Okay, two conditions. He can sell only to resident, and that
Yes.
cannot be repatriated.
Correct.
Noted, sir. Okay. So during resident period, a person was gifted by parents an agricultural land after becoming NRI. Now can he sell and repatriate?
No, that same principle. See,
Same those two
agricultural
conditions.
land he can hold because it came to him when he was a resident, so he can continue to hold. Nobody tells him that you go become non-resident, sell kar do. ऐसा कुछ नहीं बोलते. You continue to hold. But when you want to sell, you can sell to a resident. You cannot repatriate outside.
And same is the case when that has been gifted to him by the parents.
Sorry?
Same is the case of those two conditions when the
Yes.
land was gifted to him by the parents.
Gifted,
Also.
inherited, whatever.
Whatever.
Agricultural land, he can sell to a resident. He cannot
Okay.
repatriate outside India, and he cannot sell to a non-resident. These are the two things. Irrespective of how he got it.
Okay.
Of course, after becoming non-resident, he cannot even acquire. He cannot purchase. So all this has happened prior. So that is fine.
Happened during his residential status.
That is fine. But after that, he cannot even purchase. He can get inheritance after becoming non-resident. That is fine. But sale, this is the only principle.
Sale to only resident and
Resident and again non-repatriate.
non-repatriate.
Not even under 1 million.
Yeah.
Because it is a
Correct.
ban.
Noted.
It is prohibited. Yes.
Yes. Noted.
See, when any one particular regulation prohibits certain thing, the other regulation may permit you something in a general way. That general thing cannot overrule the specific prohibition.
Okay.
Otherwise, that prohibition will have no meaning. No?
True. Yeah. Noted, sir. Noted. So the NRI for NRI, does the two property limit, which is for one finance year or for lifetime?
No, it is lifelong. There is no. Once he has to once he may be holding 5 properties. 2 property तक वो बेच के remit कर सकता है. After that, a third property in any lifetime में नहीं बेच सकता. He can sell, but he cannot remit.
Another question that we have received is whether NRE account can be converted into RFC account. If yes, when?
Yeah, once he comes back to India and he has to, yes, that is one thing which I forgot to mention. Once he comes back to India, any person resident outside India who comes back to India, immediately he should inform the bank, भाई अभी मैं resident बन गया हूँ, आप उसको convert कर दो, मेरा non-resident account you convert to resident account, and he has to inform. So he can have RFC account if he is a foreign currency account, and then he can maintain. Suppose for example FCNR account is there, he can maintain. There is no harm. If he is, of course, qualifying under RFC, there are certain conditions in RFC. If he is qualifying as an RFC, yes. Otherwise, no.
With your permission, can we take few more questions because there are some questions?
Yeah, I'm okay with it. Yes.
Thank you, sir. What is the specific requirement when NRI returns to India on permanent basis, and if there are any benefits for his foreign deposits? The NRI deposits when he will be resident but not ordinarily resident, and how long he will.
See, when he comes back to, first of all, there is no concept of ordinarily or not ordinarily in FEMA. That is our concept of our income tax. That is totally different. We are not discussing that because it's a taxability aspect, or how it is taxed. As far as FEMA is concerned, it is either person resident outside India or person resident in India. There is no other conflict. Now, when he comes back to India, leaving his employment, and he settles down in India and takes an employment or sets a business or for an uncertain period in India, he becomes a resident in India, as we have seen the definition. The moment he becomes that, he has to inform all his bank accounts converted into a resident account. Now, the point is, if he at that time was abroad, he had foreign accounts, he has foreign investment, he can continue. There is no harm. He's not supposed to sell everything and come back to India. It's not, FEMA doesn't say that, aap sab kuch bech karke aa jao. Because tomorrow he may decide after 2 years, I want to go back and I want to still use that whatever resources. That is fine, allowed. But when he sells, that money has to be repatriated. Then he cannot use, suppose for example in US mein, uske paas kuch shares hai, or kuch properties hai, which he acquired when he was a non-resident. He can continue to hold it. But the moment he sells it, then that money has to be repatriated into India. Then he cannot say, okay, I will use that money to buy another property in US. No, that is not allowed because he is a resident. Now he is a resident. So whatever is applicable to resident only is applicable. He is to bring the money back into India. Then as far as the resident is concerned, he can remit $250, $250,000. That is allowed. But it has to go again from India. It cannot be wahan pe karne ka aisa allowed nahi. So that money has to come into India the moment it sells. Or if suppose it gets redeemed, suppose for example, there are redeemable items, FD is mature, redeem ho gaya, then he cannot put the money into it. He has to bring the money into it.
Thank you. What is the current RBI view on FDI with put options? Whether permitted under automatic rule and investor entitled for outward remittance on exercise of option?
No, put options are basically purchase or sale, but that is fine. So long as it's a convertible debenture or convertible preference shares or convertible, equity is of course equity. There is no question of conversion. So if put option is normally there in the shareholders agreement, the NRIs will always have a thing that yes, but then there cannot be a fixed amount. The moment there is a fixed guarantee, somebody cannot give a guarantee that I will give you 5 million after 5 years. No, then it becomes it is not a equity investment. It is a debt. Okay. So you have to have a open-ended. Whatever is the value at that time, whatever is the valuation, then you will get the money. You cannot have a fixed negotiated price. Okay, I am coming in today, but I will get 5 crores after 5 years. No, that is not allowed. Then it is a debt. Then it is not equity. Equity has got risk. No, tomorrow you may get zero. You don't know. This company may incur loss. So then that 5 crore commitment is there. No? That cannot happen.
Does FEMA provision apply for purchase of lottery tickets abroad?
No, it is banned. Period. I have mentioned that it was totally banned. Anything which is gambling, lottery, all banned.
One participant has asked whether there is any website for all the latest master directions issued in respect of FEMA.
www.rbi.org. It is there. You can search. You can search. And as Chitla sir has mentioned, a book is being published. 2 books are coming out. So in that book, a lot of things, your questions will be answered.
Today, we are directly having it from the expert. One of the contributors. Yes. Is it mandatory to get the TRC for Form 15CB?
TRC is required when you are talking about residential status. Yes, if there is an issue about residential status, yes, it is required. TRC is mandatory now. Earlier, TRC was not mandatory. But if you determine whether he is a resident of that country, because the DTA is applicable only when he is a resident of that country. Otherwise, how do you apply DTA? See, the DTA applied provisions. Suppose, for example, a person, whether he is a resident of Mauritius or is a resident of US, how do you determine? It is only because of TRC you will be finding out whether he is a resident of that country, and then you apply DTA of that country. So for that, TRC is definitely required.
Sir, if the company makes outbound investment, which is within 400%, yes. At that time of remittance, however, in future, for whatever reasons, this investment exceeds 400% of net worth, then what is the obligation of the Indian investor?
No, there is no obligation. I'll explain. Very, very good question. Suppose in March 23, the audited financial statement shows a net worth of, let's say, 1 crore rupees. So up to 4 crore that company can invest. Now, the company has invested 4 crore based on the March 23 audited balance sheet. March 24 or March 25, the company incurs huge loss and the net worth becomes, instead of 1 crore, 80 lakhs. So your 400% also reduces. But then you don't have to bring back the investment. No, not required. At the time of investment, you have to see, not subsequently. Subsequently, anything can happen. It can go up, go down, no issues. That time you're not supposed to bring back. The RBI doesn't say you bring back. It's not possible, not practical.
Correct.
So FEMA is that way very, very liberal, very common sense oriented. I mean, it is beautifully designed, so that people don't get harassed, or people don't have to unnecessarily suffer. That is what how the entire scheme has been worked out. And it is very logical. Yes.
So Form 10F, who has to file and is it mandatory?
Yes. That is for income tax. It is required. Under that, there is a section, I forgot a section. It is mentioned even in the for tax audit report, there is some 10 CCEAB something is there. I'm not sure exact name. But if there is an investment outside India, then you have to see that the limit is 6,500 crores of that turnover or something. Then only it is applicable. But I'm not sure about this 10F. I'm not sure what is the limit. So I need to reconfirm. But yes, for any investment out of India, then there is certain forms to be filled with the income tax authorities.
In ODI compliances, audited accounts of foreign entity are required to be filed. Can the same be audited by the Indian CA?
Yeah, I explained that. Now that earlier it was depending on the host country, whether audit is required or not required. Now there is a mandatory. If you have more than 10%, if your control is 10% and above, then it is audited only. You cannot have an auditor.
Whether STPI certification is required for even non-software services like accounting, legal services by Indian entities?
No, it is only for software.
Software. The abbreviation in itself is for
software is defined. Software is defined. What is software? And it has got even ITES also. ITES is slightly linked with software, but it's a little vague and little fluid. So we need to check with STPI whether your activity covers under STPI or not. And then you need to register. You have to pay some fees also of STPI.
So accounting and legal services is not. It is not.
Accounting and legal may not be because it has nothing to do with software. But there are so many things which is very got a color of software also.
Can a private limited company with authorized and paid up capital of ₹1 lakh be eligible for FDI?
1 lakh capital, any amount. There is no issue. When the money is coming in, then there is no you don't have to look at the net worth or the capital of any company. So long as a private limited company, where capital is 1 lakh. We have done several FDIs with 1 lakh capital, where 50,000 shares were allotted at a very high premium. The foreign investor came with a high premium, so it's okay. There is no such restriction. Only when you do ODI, then there is the net worth issue, and that also is net worth, not capital. Capital can be 1 lakh. You may have a reserves. In case of ODI, I'm talking about 400%. So that is again total net worth. So you can have a 1 lakh capital person can also invest, provided he has got reserves. So as far as inward is concerned, even that net worth condition is not applicable.
Okay. In case of inbound investment in LLP,
Yes.
how to value Indian LLP and which method can be applied?
Yeah, that is, you have to see, you have to go by
shares
the
of company.
Yeah, see, then no. In first of all, in an LLP, then valuation is not there. It is basically a non-repatriable basis where a non-resident Indian can invest. They have opened up LLP to certain extent, but only it is very restricted and non-repatriable basis. Repatriation allowed me. So it is based on the capital.
Okay. Is export of management consultancy service, does export of management consultancy service have separate rules? Are there any separate rules for management consultancy service export?
No, for in what respect? From the perspective of income tax? No, as far as FEMA is concerned, no. Only thing it should not fall under that STPI. If at all it doesn't, then there is no issue. You can always do management consulting.
Another question, we want to provide advance money to our subsidiary in India from our foreign holding company. Is there any limit on the amount or time period for which money can be advanced?
It's very interesting. Advance money against a business need. If there is an order, cannot be just advance. There has to be a PO. There has to be a purchase order. If that foreign subsidiary is buying goods from a Indian holding company, if there is a trading transaction, yes, it can give advance. There is no harm. The advance has to be adjusted within 1 year. That liability cannot be open for more than 1 year. If it is open for more than 1 year, go to the RBI to get approved. Then only you can get adjusted. So, you got it?
Okay.
Got the point?
I got the point, but I had another question in addition to this for advance which is received for 1 year. If it is for specific activity or maybe research related activity, if at all, of the subsidiary, the HO is giving him advance. HO is giving advance to Indian subsidiary. That has to be recovered within 1 year. But if at all the research activity goes beyond that, then
No, 1 minute. Then this is not an advance. This is an ECB. It's a funding.
Acha.
You have to apply ECB rules.
So it will not come under advance.
No, it is advances for trading. For example, if the subsidiary is buying goods from a holding company, you give advance, fine, allow, and adjust against your supply. That is fine. And again, that also happened within 1 year. That is fine. But when you're saying it is for research, that means it is an ECB which is to be returned. So it is an ECB.
It is not in form of loan or advance. It is required for business purposes then.
Yeah, but still it is an ECB.
Okay.
You have to comply with ECB guidelines.
Oh. In case of TDS on remittance, DTAA or TDS surcharge and education cess, is it applicable?
Yes, very important, very interesting. When you do TDS on 194 or 192, you don't apply surcharge and cess. But when you do 195, TDS is on tax plus surcharge and cess. All have to be, because once the payment is gone, paisa nahi aane wala. How will you recover the tax? All the tax, whatever is required, has to be deducted.
So with your permission, last few more questions because there are questions.
Yeah, I'm okay. I'm comfortable.
If FCGPR, that is the equity infusion to Indian entity, filing is delayed due to clarification sought by RBI or AD Bank, then can the late submission fee be waived by the RBI?
Generally, they levy it. You can represent it was not your fault. Suppose, for example, there was some query from the RBI. You have filed it on time. You have filed it within the 30-day period which you have been provided, and you have filed it. RBI raises some query. You have replied to the query and you have mentioned that this form which you have filed was correct and the RBI accepts it. Then if at all tomorrow there is an LSF, you can always explain that we were not at fault. But yes, some document was not properly given. For example, I will give you an example. When you filed the FCGPR, you have not filed the correct KYC. There is a KYC correct form. Then RBI raise a question, no, this is not a correct KYC form. You send the correct KYC form. So your default, you should have done it correctly in the first place. Now, if whatever the delay has happened, they will levy LSF and you will, because without that, a form will not be accepted. You will not get acknowledgement. If you don't get acknowledgement, you can't transfer. So it is better you pay LSF and close them up. And because all this is online, so you will not have much of a representation.
An Indian wholly owned subsidiary of a Dubai company wants to invest funds in its Indian subsidiary. Then how money should be infused in Indian subsidiary as a loan or investment?
Let me just understand. Let me understand. Indian company.
Indian wholly owned subsidiary of a Dubai company.
Okay.
Wants to invest funds in its Indian subsidiary. A Dubai company has a wholly owned subsidiary in India. Now Dubai company wants to invest funds in its Indian subsidiary. Then how the money should be infused in Indian subsidiary?
By way of banking channel.
Investment or increasing share capital?
Yeah, increase in share capital. You can do increase in share capital because they are themselves there's no owner. So they will bring in more money. Increase the authorized capital, they will bring in more money. So the capital will go up. It's okay. Allowed. There is no harm. You have to do, of course, the procedures, FCGPR and everything. Provided you are meeting other conditions, then yes.
Can a person who is a foreign origin remit amount to PRI to buy immovable property in India? Where?
No,
Number one.
No. Big capital. No. This is indirect way of funding, it is indirect. What I'll tell you, the principle is very simple. What you cannot do directly, you can't do it indirectly. If you try to do it, you will be caught.
Yeah. So the further questions will not even arise in that case.
Yeah.
For residents moving outside India for work, is there any list available for compliances that need to be done by that person?
Yeah, I mentioned that earlier. The moment he goes out of India, he has to immediately inform his bank, yes, I am now a person resident outside India. Give a copy of his passport, give a letter to the bank, get an acknowledgement, because sometimes the bank, makes a mistake. They will forget to do this thing, and then you are in default. You have to make sure that you have given a proper letter with the passport copy and your visa of your employment visa, your employment letter and everything, and you say that now I am moving out for employment. Now I am a person resident outside India. Please convert my accounts to non-resident. The bank, and you should of course later on also follow up with the bank and see that your account is correctly designated. And you should also inform all your investments in India, your shares, your mutual funds, with those companies and mutual fund entities that yes, I have become the non-resident and you please change my status. So this is what you have to do. And one more very important thing, one more thing, which I'm sorry, the question was not raised, but I will answer this question.
Yes.
In one recently we had one very interesting case which happened. Our client used to be, we are very compliant as far, our client was very compliant in respect of filing their APRs. There was an ODI investment about maybe 7 to 8 years ago. Every year they kept on filing APR with the AD bank because it is to be submitted manually. APR is still manual. Today also there is no online filing. We are supposed to file APR manually to the bank. We obtain acknowledgement from the bank acknowledges, puts a stamp and put the date and everything, which is before December, whatever is the due date. We have got acknowledgement. Now, as per the rule, the bank is supposed to send those forms to RBI. Then forgot. And a big bank, and it's a very reputed bank, they forgot. I don't want to name the bank, but they forgot. After about 6, 7 years, the RBI issues a notice to the company saying that you have not filed APR for 7 years. We immediately submitted all those acknowledgements which we had with the bank, and we marked a copy to the bank. They, look, we have already submitted to all this to the bank. Now it is not our duty and responsibility to see that the bank sends it. It is not. We cannot go and tell the bank, you please submit to the RBI. We have no control. They forgot. Then in fact, the RBI had issued notices and LSF and penalty and all 3 times penalty and all those kind of things. But then immediately when we pointed out all this, then I said, now it is bank and RBI, you break your head. We are not concerned. Then RBI levied some penalty on the bank. There were some problems in the bank management also. They had to terminate some people from their bank. A lot of things happened. So this is what happens. But generally, when you file APR, you must also ensure that the bank sends it to RBI. Although it is not your responsibility, but as a matter of courtesy, because otherwise, unnecessarily you will have to run around and do all this and justify that yes, you have done your job. And in fact, they went to the extent of verifying that this whatever the stamps we had were genuine stamps. To that extent, they went in forensic check kiya कि भाई हमने कुछ ऐसा गलत stamp नहीं लगाया. There also they verified. The RBI verified. The bank verified कि भाई ये stamp हमारे है कि नहीं. Then they accepted when it was all proved that yes, it was all genuine. And then they had to make some huge payment to the RBI. So this is what happened. So we although we are not responsible, but we should always better to follow.
Yes. Noted. There are some very important points you have given, sir. Thank you so much for the practical tips. So whether credit notes can be adjusted against advances received for services from foreign party? Very interesting. Very good question. No. See, for example, if you get a advance, that has to be adjusted against sales. We are talking about advance received from a customer, right? Let's presume because the question doesn't mention about it. I mean, see, I don't know, credit note you raise when there's a rejection. Yeah. So when there is a rejection, you have to prove a lot of things. You cannot just adjust. The bank also will monitor and bank also will control it. It's not that you can just by your virtue, you can adjust it, because whenever you have raised an invoice, you are supposed to receive this money as it is. Okay. Now, if there is a credit note, there is a rejection over there. Now, what happened to those goods? Those goods have to come back. There has to be a shipping document, evidence. The bank has to be proved that yes, there is a shipping material has come in. Customs have to be cleared. All these things have to happen. Then only they will allow. So that credit note adjustment cannot be automatic. It has to be through the permission with the RBI, with the AD's approval. A lot of delegation has happened from RBI to AD bank. So AD now controls all this. Yeah. So any return or compliance needs to be filed under FEMA for export of management consulting services.
No, only you have to raise, give a bill, you have to raise a bill, send it to your AD bank, and you receive the money within 9 months. I don't see there is any other compliance.
Can agricultural land be acquired by foreign citizen jointly with Indian citizen?
No, I know. Only they have permitted on one category they have permitted is suppose not agriculture तो नहीं कर सकता है, but any property. Agriculture तो no foreign citizen can even enter. Okay, and even a person resident outside India also cannot acquire. So that is out of question. Suppose if there is a commercial property or residential property, a resident Indian or some OCI is buying, and his wife is or spouse, husband or wife is a pure foreign citizen, they can become a joint owner. But that is only to the residential or commercial properties. Agriculture तो हाथ भी नहीं लगा, वो नॉन रेसिडेंट भी नहीं लगा सकता है और फॉरेन सिटीजन तो दूर की बात.
And residential property be purchased out of sale proceeds of agricultural land.
Yeah, that in India you can do it. In India, that residential property बेचा, so you do whatever. But then only you have to keep track that residential property बेच के you can't sell, you remit outside India. That was very interesting. Otherwise, what would people will do? Agricultural property बेचेगा, residential property लेगा, 2 महीने के बाद वो residential property बेचेगा. Now I'm remitting money out of residential property. No, that money will remain in India. So that residential property will become non-repatriate. When money is in India, he can do whatever he wants, but he cannot repatriate out of India, directly or indirectly.
Is Form 10F alone without TRC sufficient?
TRC is now mandatory, I think, in most of the cases it is applicable. We are calling for whenever we do any 15CA, 15CB, whenever there's a DTA applicable, we ask for TRC. Because without TRC, and it is there in the income tax also, there you require TRC. Because how will you determine the residency? There are judgments also on this.
Can we make revenue payments through credit card?
No. Sorry, what kind of payments?
Revenue payments.
Yeah, I mean, if you are doing some transactions outside India, I mean, as an individual, you can, but then you have to make sure that you are within that limit, and you have to see. I mean, we go abroad, we travel abroad, we book hotels, we book any activities outside India. When we are traveling on a holiday, we do a lot of bookings. So when you do booking, naturally it is out of credit card, you make the payment. So that is allowed, so long as it is within the limit of 2,50,000. And if it crosses that, then you have to immediately stop. You cannot make more than 2,50,000.
Dubai company, which is a partner in Indian LLP, wants to infuse funds, then how it is to be done? And how profit to be repatriated to Dubai company?
First of all, I don't think Dubai company can become partner in LLP. That
Indian
is a question
LLP.
mark. No, it is a question mark. For only Indian non-resident Indians are allowed to be partner in LLP. So that itself is a question. OCI can, yes, but not the company.
An Indian resident moving for work outside India for 4 months, does he also require to convert savings to NRO account?
For 4 months.
Huh.
If he is going outside India for not employment, not for business.
It's not stated in the question. Let's presume he is going for employment.
If he is not going for employment, he is not going for business, and he is not going for any uncertain period, he is not a non-resident. He is still a resident. So he doesn't have to do anything. He is still a person resident in India as far as FEMA is concerned. 4-month period is not relevant. Whether he is going for employment, business, and all that, that is important.
I think this is a continuation of earlier question. For material import transaction, AD bank is not adjusting debit note against payment remitted. Thus not closing the transactions in RBI record. What needs to be done?
See, there must be some issue. I don't know what exactly is the issue. Generally, see, if there is an import transaction, yes. So if there is a remittance made earlier, maybe you are given advance. But while remitting advance, did you mention the PO and did you mention that this particular transaction will happen? And subsequently, when you raise an invoice, you have to refer to that PO. And the invoice has to be submitted along with the final remittance. Then they will adjust the advance. If there is some error, some mistake in some documentation, then the bank generally doesn't do it. So you have to explain to the bank Sometimes they ask for CA certification also. In this case also, CA has to certify whether this transaction is in link with that. Suppose that advance was not related to this, something else, and now you are trying to adjust advance against this, then IAD bank may not agree. Bit of one year, no? Again, you have to see that also.
NRI gifts agricultural land to father who sells the same. Can he send as gift up to 2 million?
It is again can be considered as indirect. Although
Can be considered as?
logically there is no prohibition, but it looks indirect circuitous. So if somebody RBI might raise an objection, and you might get into criticism.
So the earlier question about the 4 months residential person, he was going for 4 months. Should he convert accounts to savings to NRO? The member has said that the 4 months is for employment.
Yeah, if he is, see, the question is not when he goes for employment, whether it is for 1 month, 5 months. Suppose I'll give you an example. Suppose I go to Dubai for a job. I start working. 4 महीने के बाद मेरे को नौकरी से निकाल दिया. So I don't become resident again. I'm looking for another job. I'm still a non-resident. So my intent at that time is to go for employment. But yes, there is another thing. If that employment is only for 4 months, is that what he's trying to say? I mean, he has gone for a temporary 4-month employment.
Looks like.
But then see, the point is, under FEMA, it doesn't say employment for 4 months or 10 months or something. It says employment. So then I think it should be a person resident outside India.
Okay, he has clarified further. Resident going outside India for 4 months for employment is conversion of saving account required under NRI. So it seems that it is for temporary period of 4 months.
He goes for 4 months, but then point is he's gone for employment. Now here that FEMA, that residential thing does not say whether it is temporary or permanent. But here only thing is that slightly dicey is that it is not a long term. It is not an uncertain period.
The
so
period
is something unusual, which is not very.
The period is also defined.
Correct. That third point is there.
Yes. Indian parent company transfers the assets and liabilities of its foreign branch to its WOS in same country, and WOS issued wholly owned subsidiary. Okay, and wholly owned subsidiary issued shares to Indian parent entity as consideration. Will it be treated as ODI?
Not allowed. Only remittance to banking channels. No assets. India, that is a condition of FCTP.
Company has received proceeds of exports, whether the bank has however, the bank has not closed it on RBI portal, and that the same is appearing in ED PMS. So how to deal with this situation?
Yeah, this is generally the query of many exporters, because when you export and then you realize money, the bank is not matching those things and closing it. We have another client who has exported long time back and realized the money also, but it is appearing as open. And then we received recently a query from the bank saying that this is open and why you have not received money. We explained that money was already received long time back, but then they said we have not closed. Then they made us give a CA certificate saying that yes, this bill was raised, this money was received against this. All this, I mean, there is no mismatch. And then they close it. So you have to go and explain the bank, you have to do the process. But why, what for they have not closed is something which is to be seen, because there must be some technical reason.
So I think I have covered all the questions so far. The chat box is flooded with compliments and congratulatory messages to the faculty. Thank you so much. The panel participants are also requesting, if at all, they can get a video or presentation of this session. I'm not sure about the process which is there at the head office. So the technical team support or the committee may come up with this clarification. But then, sir, I have tried to cover all the questions which has been asked. by the participants in the Q&A tab. And I really thank you on behalf of all the participants for such a wonderful, insightful knowledge sharing session. We are really grateful to you for your valuable time and the questions that have been answered in such a crisp and clear way that they will really go in a long way to all the participants in their consultancy that they will be giving to their clients. So thank you so much for the presentation and a wonderful time that we had discussing these questions also. Thank you so much. I would
I am
also
also
like
very
to
much thankful to all the participants as well as the committee to give me this opportunity to explain this particular very interesting topic of family. And thank you, ma'am. Thanks for your kind words. Thank you so much. I'm really obliged.
Thank you so much. I would also like to take this opportunity to thank the committee and CA Chittare sir for giving me this opportunity to moderate this session. Also, I would like to place on record the thanks to the technical team for the technical support throughout the session. Thank you so much. And to all the participants, if at all the presentation is being shared, I'm not sure where it will be uploaded, but I think it will be there at the head office website. Thank you so much for wonderful participation, and the question and answer tab was running throughout the session. Thanks a lot. Take care and good night.